along with a new change at the top. Katie Greifeld has more. Hey, Katie.
Hey, Danny. Petco, ticker WOOF, I will note. It's on the move higher today after that update. Let's start with the numbers. Fourth quarter adjusted EPS, you take a look at what we saw there. That came in at 2 cents, right on the money. The estimate was for 2 cents. Fourth quarter net sales a little bit higher than expected at $1.7 billion. It was the fourth quarter comp sales beat that analysts are pointing to as one of the reasons why you're seeing this move higher. Fourth quarter comp sales, they actually did fall about 0.9%. The estimate, though, had been for over a 2% decline, so a bit of good news there. Also, the CEO changed, like you mentioned, drawing some eyeballs today. Petco said that Ron Collin, I hope I'm saying his name right, he stepped down as CEO and chairman, and a member of the board, R. Michael Mohan, he has been appointed interim CEO. I will point out that he has been on the Petco board since March 2021. He was previously the president and COO of Best Buy. And Bloomberg Intelligence coming out with a note saying that this maybe isn't as unexpected as you might think. You think about the underperforming quarters that Petco has put up and also what they call rather desperate strategies that put into question the direction of the company. Makes sense that they're seeing a little bit of a shuffle here. I will note that even though you do see Petco up almost 6% today, it went public in January 2021 at $18 a share, currently trading below $3 now.
Katie Greifeld with the latest on WOOF. Thank you for that. From pets to chips, shares of NVIDIA are paring their pre-market gains. They're trading lower despite a big boost, I should say, from Bank of America. They now have risen their price target to $1,100, calling their upcoming event AI Woodstock. Ed Ludlow joins us now. I mean, AI Woodstock, really, Ed?
I'm hoping so, because I'm going. GTC conference, GPU tech conference, and it's actually critically important. It's interesting, the stock's down almost 2%. It jumped 7.2% on Tuesday. We could say at least there is some positioning going on ahead of GTC, right? There is going to be substantive information given there. It's a developers conference. You know, it's probably historically most analogous with Google I/O or Apple WWDC. But in this case, what the street is bracing for is a product roadmap, the next big thing. And for NVIDIA, that's probably the B100. That would be B100, not H100, B100. And that will be probably their first multi-die chip. And multi-die chips are important because what they do is basically take a large form factor and partition it into smaller form factors. That improves power efficiency. And basically, the B100 is likely to have double the performance of the H100. And the excitement around that is that if NVIDIA can tell investors, here's our latest GPU, here's how it fits into what's happening with AI, here's how quickly we can get it into production and ramp, then there'll be evidence that they can basically hold on to this competitive moat in building AI accelerators that are being used all over the world right now in the hyperscale data center context. But it is a developers conference, and I think a lot of people forget that NVIDIA's done a lot of work itself in software. Software not just in the AI context, but they're also building their own large language models. So my understanding, about 300,000 people attend GTC, both virtually and in person. This will be the biggest in-person GTC ever, but also a kind of return after the pandemic era and post-pandemic period. And one of those 300,000 will be me, and we'll do some good reporting on the ground. The stock down 2%, but as I say, that's probably a pullback from a big jump on Tuesday.
Ed, appreciate it. Yeah, Amy Wu Silverman saying that March 18th conference could be a clearing event for the entirety of the market if it disappoints. Okay, let's turn back to earnings now. Dollar Tree is falling short on both its profit and its annual sales outlook, as well as closing about 600 stores. Simone Foxman has more. Simone.
Yeah, Danny, shoppers are supposed to be looking for bargains, but Dollar Tree watching its shares fall at the moment the most since August after some pretty subpar results here. For the first quarter, it's looking for earnings per share of $1.33 to $1.48. The street had anticipated $1.71. And its fourth quarter was a little bit light as well, even though it saw revenue rise 12% on a year-on-year basis. It saw same-store sales rise 3%, but at Family Dollar, that was not the case. Same-store sales were down 1.2%. The company saying on its earnings call this morning that persistent inflation and reduced government benefits continue to pressure that lower-end consumer that comprise a sizable portion of Family Dollar customer base. You mentioned maybe this is part part of why it's deciding to close some 600 Family Dollar stores in the first half of fiscal 24. That will be added to by another 400 Family Dollar and Dollar Tree stores as their leases expire this year. Note that it operates about 16,700 stores, also mentioning shrink as a headwind in the first half. Bloomberg Intelligence says closing these stores is a needed move, though the $2 billion in impairments that it's notched suggests that closing stores does not always work, and the right formula, Bloomberg Intelligence says, remains elusive. But shares falling for Dollar Tree this morning and bringing down the shares of Dollar General, Five Below, other discount retailers as well, Danny.
Simone, thank you very much. Simone Foxman there. All right, the overall market is little change this morning with tech stocks weaker after another session of all-time highs for Wall Street yesterday. Linda Dissel of Federated Hermes remains cautious on this market, writing, though the U.S. has been on a roll, in some sense, it's the dirtiest clean shirt in the laundry. Japan is up 20% on the year. European stocks up 9% versus the S&P's 7% gain. How long can this keep going? Linda joins us now. Linda, I love this because usually we say it's the cleanest shirt in the laundry. I had to double check this because I couldn't believe that Europe has actually outperformed. So let me ask the question you did. How long can this keep going?
Well, thank you so much for having me this morning. To be clear, we have been bullish at Federated Hermes. We just thought we'd finish the year at S&P 5,200, and we're almost there as we speak. So it's been quite a momentum market, and that's what we mean by how long can this keep going on. This is a momentum market in the United States more than you have anywhere else in the rest of the world. That's leaving a lot of other stocks, particularly value stocks, behind. And so if I remember, it's an election year. You usually make all your money in the back end of the year after the election uncertainty is over. We have been tracking normally here for the first part of the year versus history, but it tends to get sloppy in the middle of the year. So we're saying it'll probably be a volatile year, but so what? Because we still think you can get the 5,200 by year end, and we may have to revisit that to the upside.
I love that. It's volatile, so what? A good reason to remain steadfast in the face of that volatility. Linda, in terms of this being a momentum market, every estimate is different as to what the trend followers are due. Goldman, for their part, thinks CTAs have been running, or UBS rather, have been running a very hefty long in this market. Part of the reason we continue to see upside, but they say if the S&P drops a significant amount, which they're saying is about 5%, you could get selling to the tune of $80 billion from those trend following CTAs. Are you concerned about the momentum nature of this market, that it can reverse quite violently and suddenly when it does?
Well, I think they're right about that. When you ask me if I'm concerned, we're saying it'll be volatile, but so what? And we want to really emphasize that because the fundamentals of our country and earnings are good, and we think that we can finish this year positively. But when a third of the market is just a handful of stocks, and stocks that pretty much everybody owns, and stocks that are right in the middle of the momentum trade, if something goes wrong, and I think that NVIDIA, which I'm not commenting on any names at all, but NVIDIA, which is a well-known household name, traded within a 10% range on Friday. That's a lot of nervous holders who may dump and give us a really nice correction, which is just what the doctor ordered, actually.
The irony, though, of this year, Linda, is if you're an active manager, the way that you beat the benchmark was loading up on NVIDIA, on those types of names. If they can be the catalyst for a correction, if you still want to outperform the market, do you need to do what you're saying and look elsewhere? Or is it still the case, if I want to do well, I got to own these AI names which are outperforming, because so far this year, again, that's the only way I've been able to do it.
Yes, and what I'd like to emphasize is that, and I was there for when the internet bubble burst, this stock market is nowhere near as expensive, nor as the leaders anywhere near as expensive as they were then, which means that if we get a pullback, we probably won't get the kind of crash that you saw then, but what you will find is that these names, which are excellent companies, their customers are rich themselves and can spend lots and lots of money, and AI is for real good. That's a market that continues, names that continue to do well, But if you believe all this, you can believe that growth really will happen, and we can find better returns on a percentage basis by looking outside of just a handful of names. We've been doing it in technology so far this year, and we've been doing it in some early cyclicals, but you can imagine that the market can expand even beyond that.
As one trader told me, the thing that people do is they wake up, they don't check the market, they just check NVIDIA. So it's a hard habit to break out of. But Linda, you write that it was not rate hikes that killed the tech boom of the 90s. Rather, it was weakening economic growth and tech spending outlooks that did it in. And at the moment, we remain on trend for tech spending. Linda, I think that's such important historical context because we've been freaking out about higher rates, and then we stopped freaking out, and then we freaked out that we weren't freaking out about it. But it is that weakening economic picture and weakening tech spending which did in the bubble. Is that at risk of playing out again?
That's the thing about human nature. We seem to like to freak out, and that's what gives us buying opportunities. So if we acknowledge that it was the economy that was weakening, and we say, okay, even around the globe, they're having to raise estimates for global GDP this year. The U.S. has been in a booming situation. We remain a very strong country, an extremely resilient consumer. And we talk about the dollar stores, and we talk about the lower income cohort, which is having trouble. We'll get some news this week on Thursday from retail sales, but the vast majority of the United States population is good. And if you look at the people in the prime age working arena, age 25 to 54, they have just a low 3.3% unemployment rate for the last 3 months. This is a consumer that's got a job, that's got money, that has lots of money to spend, spent it in a lot of places, and maybe want to spend some more in the markets.
Yep, certainly, especially if, I don't know, if you hold Bitcoin right now and it's at a record high, maybe that's something else you can put to work. Linda, we started out by mentioning that of the outperformance of Europe. The DAX also hit an all-time high yesterday, along with everything else. Just quickly here, Linda, only about less than a minute, but can you keep buying Europe given the economic issues it has?
We have slight overweights at Federated Hermes on international. That includes both developed markets and Europe. And as you're suggesting, there are a lot of cross currents. They're in trouble. Germany's the strongest sister over in Europe, and they are in an economic recession now. And yet they make new highs in the market. It's a relative game as versus the earnings estimates. And inflation comes down very dramatically around the globe, mostly EM, but also Europe, and better than here in the United States. That's the reason why we're overweight Europe, if only slightly so.
Linda, really appreciate your time this morning. That's Linda Dissel of Federated Hermes. And again, this year might be volatile, but so what? Love that from Linda. Okay, coming up, TikTok's ready for a legal fight as the House votes on a crackdown.
We're not there to ban it. I've said we want to make it tic-tac-toe. We want to make it something that is not a fearful social media platform, but one that is very positive.
Well, the latest on TikTok's fate next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Let me ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. Do you ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
My little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
This plainly is a conduct law, meaning we're acting because of the demonstrated malign national security threat of TikTok, not because of the content of anybody's speech. And the bill is narrowly tailored, which is key for First Amendment analysis, because it simply requires divestment, meaning the millions of Americans that love TikTok, I'm not one of them, but they can continue to use the application, but just in a more secure way.
I guess the commissioner doesn't have his own TikTok account. That was Republican FCC Commissioner Brendan Carr speaking earlier on Bloomberg. The House votes on the bill at the top of an hour that would force TikTok's Chinese parent company to sell it or face a ban in the U.S. Sources say TikTok is planning a full legal fight if the bill becomes law. So on Vote Watch, joining us is Anne-Marie Hordern and Ed Ludlow. Anne-Marie, what do we know about how people are likely to vote on this so far?
I'm on Vote Watch. Ed is on Buy Watch. Look, when it comes to this vote, it's likely going to sail through the House, as it did that committee that was a bipartisan support of 50-0. So those committee members wanted to see it hit the floor. It's coming under this rule suspension, so it needs to get 2/3 of a majority for it to go through. Steve Scalise, number 2, the House Republican leadership team, says that this is going to pass. When you talk about who some of these individuals that might vote against it, you could see individuals that are concerned with free speech. We see that from a number of Republicans, but also progressive Democrats. Also, many of them who are concerned about the fact that this is a way to reach youth voters. We can't forget, the Biden campaign is using this to campaign on, although TikTok is banned from use on government phones in the White House. Someone like Alexandria Ocasio-Cortez, a progressive Democrat from New York, already tweeted, Danny, that she's a no when it comes to this vote.
Yeah, the irony there is definitely not missed on many people. Ed, this isn't exactly the first time that TikTok's had this threat. Perhaps it's the first time it feels real. But what has TikTok already done to prepare, and what can they do to prepare for the inevitable outcome of this?
We'll go back to the reporting. So sources say that TikTok will wage a legal battle to prevent or at least make a sale of itself or its US operations the avenue of last resort. Go back to China's position on this. And China has also said through its own channels that it would block any such deal. And you know, we're proceeding on the basis that it's a foregone conclusion, right? Because the House is likely to vote in favor of the bill. If there are reservations in the Senate, their bigger picture about the powers this would extend to the administration in terms of oversight and censorship But I say all of that because the list of potential buyers would be small anyway, right? Think about the antitrust action this administration's taken against the biggest tech companies, Apple, Meta, Microsoft. Would they be allowed to buy it? Bobby Kotick, the former Activision CEO, there was a report in the last 7 days. He was putting together a bid to potentially buy TikTok's US operations. Rumble, the conservative social media platform backed by Peter Thiel, the stock jumped 18% yesterday on reports that it is considering a bid for US operations. How much are those US operations worth, right? ByteDance, the parent company of TikTok, is valued at around 240 billion US dollars. Well, how do you take a chunk of that, and how would they let it proceed? I think there's a lot further to run on this, and we remind ourselves that 170 million Americans use TikTok, and some of them quite like using it.
I think that's an understatement. I think maybe addicted is more an accurate answer. I mean, I like TikTok, so, you know, my full bias is apparent. Anne-Marie, Ed, thank you so much. And the House floor is gathering, getting ready for this vote. Again, it's expected to happen in about 7 minutes time. But as Anne-Marie so wisely mentioned to me during the break, this is Congress, so it might not happen at 10 a.m. on the dot. Okay, let's get to some of the sector price action this morning, and let's get over to Bloomberg's Abigail Doolittle. Abby, what you looking at?
Lots of A's here, Danny. As for the sector action, we are looking at a small decline for the S&P 500, but interestingly, most sectors are higher, led by energy up up about 1.75%. This with oil up more than 2%. Utilities higher despite the fact that yields are up. That should make those dividends look less attractive, but investors today seeking a little safety. To the downside, it's all about technology, down 1.1%, as NVIDIA is down sharply. Its worst day in a few days, a rare break for the stock that has just been rallying on that AI craze. But one really unusual pocket of strength, Danny, because of course, Chinese equities have been underperforming U.S. equities for a few years now. But take a look at the Golden Dragon China Index, up about 8% over the last 4 days. I think this is technical trading because you have this index over this time period pop above not just its 50 and its 100-day moving average, but today it's 200-day moving average. So let's see whether or not these gains can hold.
Yeah, China stocks in a technical bull market, but again, how long does that last? Abigail, thank you very much. Okay, coming up, it's the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, well, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
56 pass, about 30 minutes into your trading day. We got outperformance of Russell, underperformance from NASDAQ 100, down 0.6%. Okay, let's set you up for the day and for the week. It is your trading diary. The House is expected to vote on that TikTok bill at the top of the hour, so just a few minutes' time. The Treasury selling $22 billion in 30-year bonds at 1 p.m. Eastern. And President Biden will be discussing the U.S. economy from Wisconsin at 5 p.m. Then you get more data, U.S. PPI, retail sales, and another round of jobless claims on Thursday. And then finally, on Friday, we round out the week with the UMich Sentiment Survey. This was the countdown to the open. Stocks head lower. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock. Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
30 minutes into the U.S. trading day on this Wednesday, March 13th. Here are the top stories we're following. The TikTok on TikTok. U.S. lawmakers preparing to vote on a measure that would force Chinese company ByteDance to sell TikTok or face a ban in the U.S. We'll bring you the latest. Hovering near all-time highs in the stock market with the bulk of earnings behind us and the Fed meeting ahead of us. Where to next? We'll discuss. And grocery aisle M&A. Scott Moses of Solomon Partners joins to talk through the proposed Kroger-Albertsons merger and Walmart's growing dominance in grocery. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets this morning and near all-time highs, but a little bit lower today. If you take a look at the S&P 500, slightly in the red here, down by about 0.2%. Of course, still well above 5,100. But you take a look at the NASDAQ 100, losses getting a little more serious, down about 0.8%. Of course, that follows a big up day yesterday, so make of that what you will. And you can see, of course, volatility rising a little bit. The VIX still below 14, but inching higher and higher. But let's get to what's happening this hour, and that is the House voting on a bill that would force TikTok's Chinese parent to sell it or face a ban in the U.S. Now, sources say that TikTok is planning a full legal fight if the bill becomes law. Bloomberg tech reporter Jackie Davalos joins me now from Washington. And Jackie, how are we expecting this vote to actually go when we get there?
It's a really tense day here in Washington. And as you know, Katie, the House or the Senate haven't really found common ground to agree on almost anything except this bill. It's a bipartisan effort that was brought forth by the House Republican chair of the Select Committee on China, Mike Gallagher of Wisconsin, but it's gotten massive support from top Democrats as well. So it's largely expected to pass the House, but it faces an uncertain future in the Senate, where some lawmakers there have said they want to hold more hearings around what this could mean and the potential impact of a ban if the company decides not to divest.
And Jackie, let's get to the heart of the matter and why the U.S. is potentially looking at a ban here. Of course, this comes back to national security concerns that TikTok poses. What evidence is there to support that view?
Well, Washington has maintained that the underlying algorithm that powers this addictive nature to TikTok, keeps us scrolling, is actually being controlled by China, which has access and really purview over ByteDance, TikTok's parent owner. Now, TikTok has said that there is a wall between user data and that control. However, as we've seen, lawmakers are not really convinced. Even just a few months ago, when the CEO, Shou Chew, came on to talk about online child exploitation alongside with some tech leaders, the focus for him there was really this relationship to China. So even though they have maintained that this national security threat, there's nothing to see here, there's not much to hold there, lawmakers aren't convinced. And this is just kind of a continuation of the scrutiny that the company has attracted. Even when former President Donald Trump was in office, if you remember in 2020, that summer leading up to that election, Trump actually proposed a similar movement, to an executive order actually, to have the company divest or see a ban. So this isn't new. This effort has kind of been gathering steam. And here we are today with a vote that is looking ever likely in the House.
Well, Jackie, stay close, of course, as that vote gets underway. That is Bloomberg's Jackie Davalos in Washington. Thank you. Let's broaden out now and take a look at these markets, because joining us now, I'm pleased to say, we have Mark Spellman. He is Alpine Saxon Woods CEO, sitting on set with me. Mark, great to have you in person here.
Thank you. Good morning.
I want to start with the first line in your notes, and that is that tech stocks are currently still in a melt-up. What does a melt-up mean to you?
Take a look at the chart for NVIDIA. I think that's the textbook right now. Well, the last couple of days, you have a stock that's up basically 100%. In the last couple of days, it's up about $150. Terrific stock. There's no doubting it. They generate a lot of cash flow. They're doing this all with the cutting edge technology. It's a name you want to own. We just don't think here at $900 it's a great buying opportunity. We look for a pullback. There's a number of names that we look for a pullback for.
Interesting. So it's not a sell, it's not a buy, it's a hold.
If you own it, I'd hold it. If you haven't bought it yet, I'd wait.
Well, let's talk about the fundamentals a bit. The fact that it is a hold, it's not a sell. It's been interesting watching sort of the sell side try to wrestle with the valuations at this point. And you've had Goldman, you've had JP Morgan coming out and saying, if you take a look at earnings, they do justify what you're seeing in the stock. I mean, how are you squaring that circle?
We agree with that, basically 100%. I was doing this in 99 and 2000. There's a big difference. AI is profitable. These are real companies making real money, and the valuation on NVIDIA is not outrageous at this point, but we do get these melt-up bubbles where people can't get enough of it. So there's other names in the group, like for instance I mentioned Google. Google is a name that has been kind of get hit on the AI story because the worry is search is going to get hit. I mean, Google, more than half of their sales and profit come from search and ads sold on search. And they could be hit with AI going forward. However, you know, their AI offering, Gemini, has kind of stumbled a little bit, but we think they're going to get it together. They have terrific engineers. They have access to the greatest data of any company on earth. We think they'll get it right. And the valuation right now at 15 times free cash flow with 10 to 15% top line growth, you can't find that attractiveness much else in the group. You compare that to Apple, 20 times cash flow and 2 to 3% top line growth. So we're thinking Google actually, for new money right now, that's where we would go rather than in NVIDIA.
And Mark, it's a great point that, of course, AI, it's causing some crazy stock pops, but also to the downside, creating those gaps lower as well. But you combined two buzzwords there, so melt up and bubble. So you think that we're still in a melt up. Are we in a bubble?
I don't think so, because again, the basis of what we do at Alpine Sachs Woods revolves around free cash flow. Companies are making a lot of money right now. They're generating lots of free cash. They have lots of options to do things with that money. They can buy stock back, which is something we like to see. They can increase their dividend. They can make an acquisition. You know, that's a healthy atmosphere. It's just a matter of what you pay for it. So we're not bearish by any means. We're just looking for good opportunities and trying to discern against names we want to buy now versus later.
And so we're talking about big tech, and of course, it seems like that's all we've been talking about for the past couple years at this point. Let's venture outside, though, of that sector. You take a look at mid caps, you take a look at small caps. Small caps in particular, I know they had quite a run to end 2023, but it feels like they just can't get off their feet. How are you thinking about small caps?
We're very encouraged by the recent move in small caps. Even if with the recent move, if you compare the NASDAQ 100 to the Russell 2000 over the last 3 years, the QQQs have outperformed by 50 percentage points. I mean, that's a massive thing. In and of itself doesn't mean you buy small caps, but the recent broadening out of the market, you know, I like to call it, this is the year of the magnificent 493, and we're optimistic that things are going to broaden out.
That would be magnificent rather, if it were to happen. Tell me about the potential for M&A and how that plays into that magnificent year that could happen.
Yeah, I think you're seeing that a lot. There's a whole lot of dry powder out there. The difference, I think, this time is the private credit world, and the private world is much bigger than it has been in the past. So that might hold back like public equity kind of M&A, but we are optimistic that M&A is going to continue to pick up this year.
All right, Mark, stick with us. We have a lot more to get to. That is Mark Spellman. Please stay with us. I will note that the vote has started in the House on that potential TikTok sale or ban in the U.S. We're going to continue to follow that. You can see that voting has started. We'll keep a close eye. But let's take a quick look at what's moving underneath the markets right now. We're going to do that with Bloomberg's Bailey Lipschultz. Bailey, what do you have your eye on?
Katie, it's impossible to not talk about, Bitcoin at this point, topping $73,000 for the first time. On Tuesday, according to Bloomberg data, there was more than $1 billion in inflows into those spot ETFs, setting records really across the board. And that's really why you're continuing to see a move up and to the right when you talk to some specialists. The big thing is that there's an insatiable demand right now and not many sellers. So when you have more buyers than sellers, that inherently drives things higher. When you look back at many of the manias I've covered, Katie, meme stocks, some of these crypto one-off assets, a lot of the IPOs that come out, you see sharp moves to either direction because there are low floats of shares. And that's really what you're seeing with Bitcoin continuing to move ever higher. And it really kind of is breathtaking when you look at how it's outperformed and really stripped away from a lot of those bigger technology companies that it traditionally had tracked.
I'm glad you brought up the ETFs. It's my favorite thing to talk about. You take a look at BlackRock's IBIT, for example, taking in nearly $850 million yesterday alone has just been a real pleasure to watch. But let's also talk about a different mania, and that's what's going on in Tesla, taking another leg lower today.
Yeah, moving lower after Wells Fargo downgraded shares to an underperform equivalent. So basically is telling clients to sell the stock. I want to call this out. The analyst says Elon Musk company is a, quote, growth company with no growth, calling out the fact that sales volume only rose 3% in the second half of 2023 from the first half, while prices fell 5%. So, Katie, a lot of detractors around Tesla. We've seen the stock drop close to 30% to start 2024. When you come out and see a number of analysts continuing to pound the table for the bearish side, that really does stand out in a market that, for the most part, whether you want to call it the Magnificent Seven or the Fab Five, if you strip out Tesla and another company, it really is showing up in 2024. And that bearish call from Wells Fargo weighing on Tesla shares this morning.
So Tesla shares continuing to fall out of bed, but it looks kind of small when you take a look at what's going on with Dollar Tree.
Yeah, sharp move lower, double-digit move for the company, reporting underwhelming results, underwhelming outlook, announcing that they're going to close more than 600 stores over the coming months and year. 14% drop is really a sharp move lower for investors who had been buying into the rally over the last few weeks and months. The one thing that did stand out when you look at some of the analyst reactions is the fact that the company has a lot of uncertainty around their path to $10 of EPS. That had been something they had been pitching. And Katie, I don't know if you've been to a dollar store recently. The thing that stands out to me is that a lot of these stores don't actually sell things for $1. So when you're looking at the business, it is being kind of questioned, if you will, by a number of these companies. And that's why we're seeing, or a number of investors, that's why you're seeing stocks like Five Below trading lower in sympathy.
Inflation is everywhere. Bloomberg's Bailey Lipschultz, thank you so much. Now coming up, Amazon and Eli Lilly team up to bring weight loss drugs directly to consumers. Details next. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Well, some big news out today. Drug maker Eli Lilly teaming up with Amazon to sell weight loss drugs. Zepbound will now be available through Amazon's pharmacy, delivering the GLP-1 drugs right to consumers. Bloomberg's Madison Muller joins me now with the details. And Madison, so this is part of Lilly Direct, correct?
Yeah, so this is part of Lilly Direct, and I spoke with executives at Lilly, and they said that this is just the next phase of expansion as Lilly Direct continues to evolve. We know that it just came out in January, so they're still trying to grow it, and this is the latest phase of that.
And so, I mean, this would theoretically make it easier for consumers to get their hands on some of these drugs. How does that fit in with the supply shortages that we keep hearing about?
Exactly. So that's part of the reason why Lilly started LillyDirect, is because it's just been a hassle to get weight loss drugs for many patients because of the supply shortages. There's so much demand, and then just general issues with the U.S. healthcare system in general. So this latest initiative from Lilly is helping with turnaround times, ideally, and Amazon is also hopefully going to help with that as well, and just helps patients connect directly with doctors, and then also have that home delivery of their prescriptions as well, if that's the right option for them.
And before I let you go, what sort of uptake has Lilly seen through the likes of LillyDirect so far? Do we know that?
So we don't have exact numbers yet, but Lilly's CEO, Dave Ricks, did say yesterday in an interview with Bloomberg's Caroline Hyde that already they are seeing extremely successful results, strong uptake, so much so that they're actually having trouble keeping up with the demand for this service.
All right, Madison, great reporting as always. Appreciate your time. That is Bloomberg's Madison Muller. Now let's keep the conversation going now with Mark Spellman, who remains with us. And before we went to break, of course, we were talking a bit about Google, sort of an underloved AI play. You take a look at its valuation, definitely trading cheap to some of its peers. But along that theme, what other names have been sort of overlooked when it comes to just this AI euphoria that we've been witnessing?
Sure, there's a couple of names. And in industries, when you think about the data center world, it's a major beneficiary from AI. You look at the HVAC world, air conditioning and ventilation, believe it or not. I mean, huge. Trane, increased its backlog by about 25-30% in the end of last year for commercial projects. Read data centers. The runway for Trane's business, now mind you, they do Thermo King and Trane air conditioning, the runway there is multiple years. Now that stock has done very well, and it's about 28 times earnings. I put that on my list of names I want to own. If you don't own it yet, wait for a little bit of a pullback. Where you can, the second derivative below that is Carrier Global, 8 multiple points cheaper than Trane. Trane's outlook is a little better than Carrier's right now, because Carrier has a little bit more residential and it has more Europe. So they're not hitting on all cylinders like Trane is. But from a valuation standpoint, new money, we would say Carrier Global.
Can you walk me through that a little bit more? So I understand it's a second derivative AI play, but how does AI fit in with an HVAC company?
You got to cool those machines when they're in the boxes, and it's massive. And it's not just that one play. Look at a building like the Bloomberg building too. Air quality is a huge deal post-COVID. Nobody wants to come back to work unless they feel safe. The air quality issues have been a huge boon to a company like Trane. Retrofitting new buildings, plus you have new regulations from refrigerants, that's helped them as well.
Okay, so we have the Googles of the world, of course, that can help sort of more directly when it comes to their search business. Then you have the second derivative plays. What about the picks and shovels? I mean, how are you thinking about chips right now, about the likes of NVIDIA? Is that just too hot to handle?
It's again, I would say NVIDIA, great company, want to own it. Own it if you have it, wait if you don't. If you want to get in the more of a value situation, Hewlett-Packard. Here's a name that did tremendously well during COVID. Obviously, work from home was a huge boon to them. Everyone got a new laptop and a new printer and buying lots of ink and stuff like that. And then the growth rates fell off a cliff, as well they should. However, Hewlett could be hitting another cycle. There's two major things happening. AI, they just announced the whole new line of computers with NVIDIA, which is perfect. I mean, that's the best partner you can get. That'll be launched in the second half of this year. In addition to that, Windows 10, if you remember what that is, officially,
I've heard of it.
Exactly, officially dies later this year, and there's a replacement cycle for old PCs there. So we think this is a name with an outlook that the earnings could surprise to the upside 12 to 18 months out. If you get $4 in earnings, you have a name that's 9 times earnings right now, selling at $30, a 3.8% dividend yield and a 10% free cash flow yield. It's retired, I think, 40% of its shares outstanding in the last 5 years. We think that's a real good risk return right now. A name you might not think as an AI play, but definitely a second, maybe third derivative play for AI.
Well, that's what I want to talk about, because clearly you're doing your due diligence. You're finding these second and third derivative plays. But what is the catalyst for the broader investing community to sort of wake up to that narrative? Do you just have to wait for earnings, or what actually will put this into the zeitgeist?
I think that's exactly right. I mean, you hit it. It's earnings and cash flow. It sounds like a great story, but Hewlett-Packard's recent results aren't showing any benefit really from AI. However, 12 to 18 months from now, if you get that 9 multiple, if they can show that they are a participant in this AI cycle, that 9 multiple will go dramatically higher, and that's where you'll make a ton of money. And if they can positively surprise on the EPS side and expand their multiple, it'll be a real good stock.
So definitely something to watch there. I want to circle back to what we were talking about, though, when it comes to these smaller and mid-cap sort of names. When you look into the indexes and go under the hood a little bit, where are you seeing the opportunities when it comes to specific companies?
Yeah, it's very one-off. It's less thematic. I think the theme would be broadening out in that magnificent 495 that I discussed. You know, we have a name like IMAX, the theaters. They don't own movie theaters. They license their name. They license their technology. Stock did terrific last year, basically because of Oppenheimer and a bunch of other names. The writer's strike kind of put a kibosh on new movies. Probably won't see a lot of big blockbusters till later this year. The stock has net cash on its balance sheet, has a big business in China, so it is a China play, and the movie going is very good in China. IMAX has also expanded their product offering to a lot of local language stuff, so it doesn't just have to be English-speaking blockbusters out there. And they've done a real good job, and they've bought back a lot of their stock too. We think that's an interesting name. You know, honestly, from an M&A front, I mean, I think this could definitely be something, and if that were to the case, $25+ per share is kind of what our target is on a deal.
So definitely something to keep an eye on there. I will note that Dune 2 did come out.
Dune 2 has been a big
deal.
upside surprise, really. I mean, it's definitely doing better than they had thought. So the stock has popped a little bit, but I wouldn't worry about that. At 16, 17 bucks, it's still a buy here.
All right, Mark, we'll really enjoyed this conversation. Hope to speak with you again soon. I think we covered quite a lot of ground. That is Mark Spellman of Alpine Saxon Woods. Thank you. Now, still ahead, we're going to take a look at the companies that are making the most social buzz today. That's in our Social Climber segment, up next. This is Bloomberg.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, we have Volkswagen, expecting orders in Europe to pick up speed as it updates popular models. Now, the German car maker's CFO spoke to Bloomberg TV earlier on his outlook.
2024 will be a challenging year. We have macroeconomic environment is like uncertain. We have interest rates still high. on inflation on the cost side, and there's a lot of competition in the BEV markets. But there are also positives. The market will grow slightly, and we bring some great new models specific.
Meanwhile, the company facing a lot of headwinds, including softening demand for EVs and growing competition from cheaper Chinese models. Next up, we have Allbirds. It's gaining traction on social media. The wool footwear company issuing a weaker than expected outlook for revenue, and analysts saying there is limited visibility into improving sales, and the recent departure of its CEO isn't exactly helping confidence all that much. And finally, we have Petco. It's losing its top dog. The pet health and wellness company announcing its CEO will step down. A member of the board will serve as interim CEO until a permanent CEO is found. Also worth noting that the company beat fourth quarter earnings estimates. That's certainly helping shares out this morning. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. You take a look at the broader markets right now. It's pretty quiet out there, quiet to down. You take a look, of course, at the S&P 500, for example. You can see we're down by just a hair, about 0.1% or so, slightly more if you take a look at the likes of big tech. The NASDAQ 100 currently off about 0.7%. Of course, we had a big green day yesterday, so maybe the market's taking a little bit of a breath at this moment. Now coming up, the FTC's suit to stop the Kroger-Albertsons deal is set for trial. We're going to speak to Scott Moses, Solomon Partners' partner and the head of the proposed Kroger-Albertsons deal next. This is Bloomberg.
Ursula Hurley walked me through Terminal 5 at New York's John F. Kennedy Airport, where the complexity of the business she oversees really comes into focus.
We operate 1,000 flights a day, we serve over 100 destinations, and we transport about 40 million customers per year. When you think about a person booking a flight to getting them to their destination and home from their destination, it takes an army of things to go right.
There's change on the way at JFK. Ground has been broken on a new Terminal 6. It will connect with Terminal 5 and add capacity for up to 10 gates. JetBlue joins a consortium of companies managing the $4.2 billion project, helping define its design and guide its construction towards completion in 2028.
We're still in the design phase for Terminal 6, but we leverage what other airports have done and what we've seen throughout the world, quite frankly, and we're going to pick the best of everything to really elevate the game. And technology is going to be at the backbone of that journey. We want to be able to create and give customers experiences where they can self-serve as much as possible across the travel ribbon. So whether it's checking in, whether it's checking your bag, going through security, boarding a flight, we want everyone to be able to do that seamlessly and be able to do that with your own handheld technologies.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Well, Well, the FTC has set a trial date in August for the proposed $25 billion merger of supermarket giants Kroger and Albertsons. The FTC, 8 states, and Washington, D.C. have sued, claiming that the merger would lead to lower wages and higher prices for customers. Now, the supermarkets say they need the merger in order to compete. I spoke with Spartan-Nash CEO Tony Sarsam on the state of grocers on Monday morning.
Independent grocers is our primary customer that we serve, and that's a wholesale customer. So we serve about 2,100 of them overall, 2,150, something like that. And there's about 21,000 of them in the United States. These are folks that operate, typically as family businesses. They operate in an inner city where there otherwise might be a food desert. They operate in the suburbs sometimes, but most commonly, they're in small communities across the entire United States. And those, they're small, family-run business, and they rely on wholesalers and folks like us to help solve their problems and help think about how they can run their business efficiently. They look to us for the tools, whether IT tools or category management tools or insights we can provide. And of course, they look for us for that overall supply that's consistent and predictable, and the pricing makes sense for them as well. So all of that makes up how we actually manage through that. And so, to your question, the retail and the wholesale is sort of the same thing in a way, right? We're serving them. They run retail stores. We run retail stores. We see the same types of trends, but because of our scale broadly, we can offer what a $10 billion company can find and offer to a two-store family chain is really invaluable to those folks.
Well, before I let you go, I want to talk about one of your key wholesale customers, and that's Amazon. Of course, business from Amazon, it's been slowing as they pursue their own efforts there. How do you make up for that lost business? What does your planning look like right now?
So we're doing the same types of tools that I mentioned a moment ago. We're looking for ways to grow organically in our stores and with our wholesale partners, make sure they have the right offer for their shoppers. And we're also evaluating inorganic opportunities all the time. So we're looking for those ways to continue to grow. And we actually are bullish on Amazon. We believe they're going to come back and grow. And so we want to make sure we're a good partner for them. And when they're ready, then we're going to be ready for them.
And that, of course, was my conversation with Spartan-Nash CEO Tony Sarsam on Monday. And we have a great conversation coming up, but we do want to bring you some breaking news right now on that TikTok vote. And that is that the House, it has enough votes to pass the divestment bill. And joining us now with more is Bloomberg's Jackie Davlos in Washington. Jackie, what do we know right now?
Well, now we know that this bill moves to the Senate, where it faces a much more unlikely future. Here, you had largely bipartisan support for imposing this deadline of 180 days for TikTok's parent owner, ByteDance, to divest and seek either a new buyer for TikTok or face a ban. Now, you have an interesting dynamic going on here. If you look at some of the nays, you have pretty prominent members of the House both coming in opposition. For example, Representative Marjorie Taylor Greene actually sided with former President Donald Trump, who had expressed his own views on opposing the bill earlier this week before it came to a vote. She says that this could actually lead to other similar bans for other apps, something that, is a cause for concern, perhaps some government overreach there. Then you have a Democrat, AOC, Alexandria Ocasio-Cortez, also coming out in opposition, saying that many people depend on this app and that this process was just too rushed. So now you have the House clearly voting to move this forward. Whether or not TikTok's lobbying efforts on Capitol Hill, which have been directed toward the Senate at this point, will be effective is still yet to be seen.
All right, Bloomberg's Jackie Davlos, thank you for that instant reporting there. Of course, on the breaking news that the House has the votes to pass that TikTok divestment bill. Of course, the vote is still ongoing, and we're going to continue following that one. But let's pivot back to the grocery store, and specifically grocery M&A and the proposed merger between Kroger's and Albertsons. And I'm pleased to say that we're joined now by Scott Moses. He is partner at Solomon Partners. He's the head of the Grocery, Pharmacy, and Restaurants Investment Banking Group. And of course, he's also the head of the proposed deal between Kroger and Albertsons. So, Scott, we talk about that deal. I mean, initially proposed back in 2022. It's been a long path to here we are now. How confident are you that this deal will actually close?
Well, I'm very confident because this is not some abstruse industry that we don't understand. We all know the facts here. Our friends, our families, our colleagues, they all shop at Walmart, Target, Costco, Amazon and Whole Foods, Aldi and Trader Joe's and Dollar General. And out west, they shop at a long list of other grocers like Sprouts and Cardenas and 99 Ranch and Grocery Outlet, Winco, and New Seasons. So the FTC is describing a grocery industry that we haven't seen in decades, right? I mean, quite candidly, I think you need a DeLorean, a Huey Lewis cassette, and Marty McFly to take you back in time to the 1980s to shop there. It does not exist in 2024.
Well, that would certainly be fun if that was possible to go back to the 80s. But let's talk about some of the remedies that have been proposed to actually get this over the line. You go back to September of last year, and the two stores, you began talks of selling more than 400 locations throughout the country to C&S. Does the FTC accept those divestitures as a remedy here?
Well, clearly the FTC has, articulated some questions. But the fact is, C&S is a very strong divestiture buyer. And you had Tony Sarsimon from SpartanNash a little while ago talking about how well, as a supplier, their infrastructure serves, their different retailers around the country. The fact is, C&S is 40 or 50 times larger than the Hagen transaction that a lot of folks talk about. C&S is one of the largest grocery suppliers in the U.S. It's the 8th largest private company in the U.S. It's owned by one of the wealthiest families in the U.S., and it's got over 100 years of grocery operating experience, $20-some billion in revenue. It supplies over 7,000 stores with extensive infrastructure across the country. And unlike Hagen, they're going to be acquiring or licensing the banners of the stores that they're buying, which corrects a key mistake. That will help with continuity, and it'll help make sure that they can use their strong balance sheet to invest in price and wages and marketing in ways that Hagen didn't. They've also got a deep management team with extensive acquisition and integration experience. And remember, the FTC validated C&S as a divestiture buyer just 2 years ago in a merger here in New York State between Price Chopper and Tops. And by the way, those stores are doing very well now.
Points taken there. Should we expect more divestitures, of course, from Kroger's and Albertsons as we potentially count down to the closing here?
Well, I can't speak to the negotiations that have been ongoing between the FTC and Council. But what I can say is the grocery industry is radically different than the one that the FTC describes, okay? It's got not just supermarkets, but super centers and club grocers, discount, dollar and drug grocers, specialty, ethnic, and online grocers. And yes, supermarket grocers as well. Remember, the USDA actually allows SNAP purchases of groceries at all of those different grocers, right? So I think that's a pretty good indicator as to just how broad the grocery industry is today. Remember, supermarkets only comprise some 36% share in grocery today. They're down to 5 of the top 15 grocers. They used to be 10 about 20 years ago. The other 10 of the top 15 are these national discount grocers like Walmart, Target, Costco, and Amazon and Whole Foods. And they've got 64% share, and they are rising fast.
And I do want to just bring us a headline as we continue to follow that TikTok vote. This crossing the terminal right now that the U.S. House passes the bill that would force TikTok sale or face ban, of course, that divestiture from their parent company, ByteDance. We're going to continue to follow that one. Of course, it goes to the Senate now, and we'll see what happens there. But, Scott, I do want to talk about, of course, the heft of Walmart and the likes of Amazon when it comes to grocery. But before we get there, I do want to talk about some of the pushback to this deal. I mean, in addition to the FTC, you also had the United Food and Commercial Workers International Union saying last May that they oppose this merger, that it poses a, quote, serious threat to members' livelihoods. How do you think about those responses? What would this potential merger mean for salaries, et cetera, when it comes to the people that actually work at these stores?
Well, first, I think it's important to say that grocery teammates around the country are incredibly important. Okay, they were the unsung heroes feeding the country during COVID, and they have been in crisis after crisis. So with that said, though, union jobs have precipitously declined at our top grocers around the country as the non-union national discount grocers have grown so much. Conversely, Kroger has added over 100,000 union jobs in the past decade, and they've committed, in addition to lowering prices day one with this transaction, they've also committed that they're going to increase wages by $1 billion. They're going to invest $1.3 billion in better stores, which strengthens those jobs. They've said there'll be no store closures, no frontline job losses, period, full stop. And the transaction was endorsed by Local 555 in Oregon, Washington, Wyoming, and Idaho. They've got 18,000 members, and they clearly articulated something with which I wholeheartedly agree, which is Albertsons is for sale, is going to be acquired. And they would much prefer that the buyer be, as it'll be here, Kroger and C&S, rather than some non-union or anti-union company like Amazon.
Well, Scott, that's kind of what I wanted to get to. I mean, if this merger doesn't go through, what do you see as the path forward, both for Kroger's and also for Albertsons? What would potentially be the next plan?
Well, look, my focus here is on the facts and the data, okay? And the facts and the data very clearly imply that this transaction is very important to help lower prices for consumers around the country and to help improve wages and stores around the country as well. Now, the irony here is that the real beneficiaries from trying to block this transaction are the enormous non-union national discount grocers like Walmart, Costco, and Amazon, okay? It's almost as if the FTC is putting their thumb on the scale to support them. Now, that may not be the intention, but it's undeniably the result. And if supermarket grocers aren't allowed to level the playing field, it won't be long before grocery looks like department stores, with thousands of supermarkets closed and millions of union jobs lost. That's what we're trying to prevent here. And quite candidly, I've been doing this over 20 years. That's what I've been trying to do my whole career, to help keep supermarket grocers open and vibrant and a part of our communities so they can continue to serve them.
All right, Scott, got to leave it there. Really enjoyed this conversation and appreciate you rolling with the breaking news. That is Scott Moses of Solomon Partners. Let's get a check on the broader markets right now. We're going to do that with Bloomberg's Abigail Doolittle.
Well, relative to big tech, Katie, it's not so positive. You can see here the NASDAQ 100 down about 0.7%. In fact, over the last 4 days, down more than 1%. A lot of this having to do, at least today, with NVIDIA down the last time I looked, 3.5%. Some chips being taken off the table from that big rally. Relative to some of the other indexes, it's a little bit more mixed. The S&P 500 may still be down ever so slightly, down about 0.1%. You can see the stocks, though, in sympathy with NVIDIA trading off down 2%. On the other hand, small caps up 0.6%. And take a look at the Golden Dragon China Index, that China Tech Index, up 2.2% up for a fourth day in a row. In fact, up almost 5%, or excuse me, 8% over the last 4 days. A technically driven rally with that index going right above its 50, 100, and 200-day moving averages. Let's see whether or not it can hold. Relative to the S&P 500's technicals, this point cannot be overemphasized, or at least that's my feeling on it. We've been looking at this chart for quite some time, and it's continued to grow. This is the S&P 500 over the last year, so you can see this nice uptrend. But what is happening is as the index makes more and more highs, record highs, the RSI is not gaining ground. In fact, right now we have this RSI at a 65. So the recent record high at a much lower level than what it was last December. That basically tells you that there's less momentum, less enthusiasm on the part of the buyers. Maybe even you could say weak hands buying from those who bought well back here. Relative to some of the movers beneath the surface, well, let's take a look at Williams-Sonoma, up 18.8%. They boosted their dividends and buybacks. It was also a solid quarter, very nice day there. I think that there's a decent short interest. Alphabet up 1.2%, and some of it having to do with their AI chat box. And then Tesla down 3.8% over the last year. This is hard to believe. Now down over the last year. This, of course, is Wells Fargo is making the call. How can you have a growth stock with no growth? Downgrading it to the equivalent of a sell. And then Dollar Tree's down 14.4%. The 1Q earnings guide, Katie, not great. They're also closing $600 general stores, 1,000 stores overall. The CEO saying that for the lower income shopper, that there's more deliberation, that they're less certain.
Yeah, quite a wipeout we're seeing today in Dollar Tree. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, investment opportunities in India. We'll have highlights of our interview with Henry McVeigh, KKR Head of Global Macro, Balance Sheet, and Risk up next. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, well, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
All right, it's time now for Wall Street Week. And earlier, Bloomberg's David Weston sat down with Henry McVeigh, KKR head of global macro, balance sheet, and risk, and asked him about his recent trip to India and what improvements he's seen since his last visit to the country over a decade ago.
When I first joined KKR in 2011-12, we wrote a piece and we said, this is what India needs to do to hit its potential. One of them was invest in infrastructure. The second was reduce its deficits. It had twin deficits. And the third was stop subsidizing everything and let the real economy do its thing. And I was just back there recently, and you can see from our piece, I mean, they have done those. I mean, a lot of credit to Modi. He's done an excellent job. But when you look at it right now, massive investment in infrastructure, particularly around roads, which is critical to that economy. Second is around data and making sure that you can actually have the technology do what it's supposed to do as it relates to the internet. And then finally, I think about all the stuff around the rule of law and making a better bankruptcy court. That's something where foreign capital now wants to be in India, and it's more active. And so it's a pretty good environment right now. As you mentioned, a lot of people are thinking, where can I get emerging markets growth? And what you see is while I'm talking about this latest update, India's public equity markets have been outperforming by about 700 basis points for the last 10 years. So this story, it's a growing one. It's getting better, but it's not a new one.
So those reforms you talk about, how do they manifest themselves in economic numbers? For example, growth. And by the way, we've always been concerned about inflation in India.
Yeah, so there are a couple of things. One is real GDP has gone up since the past couple of years. There's more consumption in the economy. I think you're seeing the rise of the middle class, particularly the middle to slightly higher class. They're really starting to spend, and they're enjoying the benefits of that. The second is everybody now has a digital bank account, and so the government can be much more targeted in terms of doing fiscal subsidies, making sure that money is being transferred properly, country. And then the final thing is, unlike China or the United States, India has really created a technology platform that is agnostic. So their version of Amazon or the search engines is actually just to have something that's open to everybody, not having one private sector company control that. And over time, that could be a differentiated model. It's still early days, but those would be a couple of big changes we're seeing.
So let's unpack a couple of those. One is personal consumption. There's a lot of talk about China and the fact that they're trying to get a more consumer-driven economy. Haven't necessarily succeeded thus far. What progress is India making, and how is it making that progress? What are they doing?
So the good thing is they don't have to start by increasing from exports to consumption. The economy is almost, I think, 65 to 70% consumption to start off with. So it's really about increasing GDP per capita. That's why it's so important they keep inflation down, because you need to see real GDP per capita go up, which is tough in an economy that often has inflation. The second thing is they've done things around taxation to make sure there's something called the GST tax, where it's made it more efficient. So you actually have the ability to transport goods across different regions within India. In the past, you've had waste, and it's taken time, and the toll on actually getting the goods from one area to the other has been much worse. So that's improving. And then the final thing we're just seeing is there's more confidence in the consumer. We have exposure to different types of financial services companies in India, and actually the loss rates are down. So there's a confidence where people, they want to invest in their businesses, they're actually paying off their debts, and the consumer is spending a little bit more. If you contrast that with a country like China, is less than 40% consumption, the savings rate is way up, and they really had made their growth through fixed investment. So you need all the different food groups. You need fixed investment, you need exports, you need consumption. But what makes India unique relative to some other emerging markets is they don't have to export their way out. And in a world where we've got a lot of volatility, we've got some unnatural acts around geopolitics, having a strong consumption base, be 2/3 or more of your economy, is actually a winning formula.
So give us a peek at your playbook, if you would, at KKR. I mean, you went over there to look at it as an investment opportunity. For investors watching this, where do you see the investment opportunities?
I think there continues to be, India has a wonderful set of large conglomerates that are going to grow both in India as well as in around the world. They also, I think they've done a lot around technology, retail, telecommunications. We've been partnering with some of the larger companies in India to really bring foreign capital and some expertise around industries. That's been a great relationship for us. So that's one big area. You can play that through public markets or private markets. That's through our private equity at KKR. The other area that's really growing fast right now is around infrastructure. The government is looking to move $4 to $5 billion out of the public into the private hands per year. Toll roads, transmission of energy, data, all that area, that is booming. And India is more known for the public equity markets, but there's a huge amount going on in infrastructure, and the government really is supporting that privatization, and it's going to, I think, make a difference in the efficiency of the economy. And then the third one is around credit. What you're seeing there is more of a credit society. I think that's something where you need to make sure you're partnering with the right companies to lend, but those are really the big groups where we've been focused. And then obviously real estate remains a big area of focus within that economy. Particularly, they had a housing kind of bust and too much credit in 2018 and 19, right before the pandemic, and I spent a lot of time there during that and kind of watching that downturn. What you're seeing right now is actually that real estate sector do very, very well, and that's gonna draw investment too.
And that was KKR's Henry McVeigh sitting down with Wall Street Week host David Weston. This is Bloomberg.
Regional sports networks. There's a lot, it's a business that seems to be collapsing. leagues have sort of toyed around with. Should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
We do want to revisit some breaking news over the past hour, and that is the U.S. House passing a bill that would force TikTok sale or ban it altogether. Of course, it is the most serious challenge yet to a service that's used by 170 million Americans. This measure passed Wednesday by a vote of 352 to 65. Of course, it goes to the Senate now, where it has a much less certain future, though. President Joe Biden, he has said he'd sign this legislation, even though his campaign recently joined TikTok. Now coming up, T. and Klein, Edge and Node CEO. She joins BTech next. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
This is Bloomberg.
innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we will have full coverage on TikTok throughout this program. The US House, it passes a bill to force ByteDance to sell TikTok or face a ban in the US.
Plus, the European Union passes the world's most extensive AI guardrails. We'll break down the impact of the AI Act and what it means for the future of artificial intelligence.
Chamath Palihapitiya's social capital, it fires 2 partners after a probe citing an undisclosed situation. We'll discuss what could be behind the decision that involves a much-hyped AI startup. But first, check in on these publicly traded markets. After yesterday, yet more records to be had. Today, we just ease back a little bit. No major macroeconomic data on the table, and instead we just digest where indeed the Federal Reserve might go, what the inflationary pressures are. We're off by about 0.6%, maybe a bit of profit taking being had. I mean, Stock 600 actually managing to fight off some of the doom and gloom scenarios happening in the US at the moment, and we're in fact up 0.2%. Not big, but some key AI fervor still happening over across the Atlantic. 30-year yield pushes higher. Maybe this what dictates trade here in the United States. Quiet in equities, but we see the bond market 30-year auction. There was pretty lackluster demand yesterday. Will we see this take up? We see yields just push up about 3 basis points. Moving on from that into the world where, well, we just don't catch a break in terms of the run-up. Bitcoin once again powering up 2 percentage points on the day. We're in eclipsing that 72,000 at $1.73,000 handle is where we were on Bitcoin. But Ed, what are you watching on the micro?
Social media names. These are Rumble, Meta, Snap, and Alphabet, parent of Google, which of course owns YouTube, over the last 7 days. But the moment that the House did pass the divest or ban TikTok bill, there was a significant leg higher in both Rumble and Meta. But I put those up because the conversation will now change, right? We're going to discuss whether the divest or ban TikTok bill will have success in the Senate, but we're already saying this is a foregone conclusion. And we're asking, well, who is going to benefit from a TikTok ban in the US, or who is going to buy TikTok's US operations? And look at Rumble, its gain over the last 7 days, much of it in yesterday's session, on reports that they're considering a bid or looking at options for TikTok's US operations. There's a lot to discuss, but the big step in the House has been taken. Now we move to the Senate.
And still much potential pushback from the Senate, and notably a CEO who went there to lobby just those senators yesterday. Let's get into it with Alex Barinko. And Alex, we understand, according to people familiar, that Shou Chew was indeed looking to target senators in particular.
He was. I think the TikTok team saw this bill potentially flying through the House like it did today, getting that majority vote in just the past few minutes. The next hurdle for them will be the Senate. Majority Leader Chuck Schumer in the Senate has so far not said that he would take up this bill. TikTok also put out a statement today appealing to senators saying, quote, "This process was secret and the bill was jammed through for one reason. It's a ban. We are hopeful that the Senate will consider the facts, listen to their constituents, and realize the impact on the economy." So certainly TikTok CEO Shou Chew, who was down in D.C., is going to be spending his time in the Senate, hoping that while this is the furthest a anti-TikTok bill has gone in the U.S. government, that it ends here.
It's not just that Chuck Schumer has not endorsed the bill. It's that there is a bigger concern here as well. And Bloomberg's reporting this idea that even on the Republican side of the aisle, they look at this bill more big picture. Why do we hand these powers to the administration and give them such sort of a blanket power for censorship to make a decision on TikTok? So that's there in the background. But I think I'm right in saying, Alex, TikTok's always said that it's going to mount a legal challenge to the idea that it would have to divest or sell its US operations anyway.
Yeah, you're right. I think it was summed up pretty succinctly to our D.C. colleagues by Republican Senator Tom Tillis out of North Carolina, who said yesterday that he's worried about the unintended consequences of a bill like this. Now, it's been fascinating, Ed, to kind of watch the battle with TikTok in D.C. because Republicans writ large have been some of the biggest agitators against TikTok. Some of that did change in the past week when we had Donald Trump himself, when he was the president who put the first executive order order forward to ban TikTok actually come out and say a few days ago, well, maybe we shouldn't do that because it would give Meta too much power. So certainly we have some wrangling here, not only over whether or not this bill actually addresses concerns or if national security concerns have actually been made clear to the lawmakers, but also how much power this would give the government, this would give the executive branch in kind of ruling over the private sector.
And I point out that in that moment that the House passed the bill, there was a big spike in Meta. It is still lower 0.7%. But of course, TikTok's user base and its platform is highly analogous with Meta's Instagram short-form video vertical. Bloomberg's Alex Barinka has done a masterful job of covering all of that. That is that spike in Meta shares that I showed you, but then an immediate pullback. Right, so sources say that TikTok intends to exhaust all legal challenges before it considers any kind of divestiture from its Chinese parent company, ByteDance. Let's bring in David Glancy, Institute of World Politics Professor and Strategy and Statecraft and Annenberg Chair of International Communication, for his point of view. For many, David, this was a foregone conclusion. Divest or be banned. Is it as simple in your mind?
I think from the national security community, it's a pretty simple issue. It is a potential threat to national security because of its reach, the way the software is, the potential to influence, but also the close relations. It is a Chinese company. And there was a report that came out just on Monday, an unclassified report on threats, a threat assessment, and China was prominently featured in that. And China's activities in the last few years have been much more aggressive. They've been working with adversaries like Russia and Iran more closely. And so I think there's real concerns. And from the national security community, it should have been done probably years ago.
Now, of course, we know that this has been considered for a long time in terms of the worries of Chinese influence. And TikTok itself, Shou Chew himself, has gone to lengths to say, look, we can alleviate that. Project Texas, for example, ensuring that Oracle is in some way facilitating the way in which data is read or indeed not transferred to China. How much have you read into, well, the ability for that to ease any of your concerns?
The fact that it's a Chinese company and still has to abide by Chinese laws, which, when push comes to shove, would require data transfers. The other major concern is their algorithm and the ability to potentially push influence messaging that we wouldn't be able to detect in real time. It would be really difficult to detect some of their longer-term influence activities if they were to shift their algorithm for more malign purposes. And that's a real concern for the national security community.
David, 170 million Americans use TikTok, and many of them like it. Are they being represented in this process?
I think the Senate's going to have its say. I think the fact that it's been delayed for a number of years and there hasn't been action, that's a testament that they have been. There's been a voice for those folks in the process. So I think we have a system of laws and rules and ways to appeal, and there's a lot of different avenues for people to have their voices heard. And I think that's a strength of the U.S. From the national security community, at least, this is sort of a no-brainer that the action should have happened a while ago.
You've worked in the State Department, the Defense Department. If this doesn't go through, what does that mean for China and U.S.?
I'm actually a little bit concerned. If the Chinese government thinks that it can block policy action on important issues by appealing to domestic political factions or special interests, then I think that makes a more dangerous world. That may embolden the Chinese to be more aggressive, and it increases the potential for direct U.S.-China conflict in the years ahead.
We want to thank you for your time, your expertise, Institute of World Politics Professor of Strategy and Statecraft and Annenberg Chair of International Communication. That's David Glancy. We thank you. Coming up, more regulation, this time from the EU. It passes a landmark set of AI rules. We'll have all the details for you. This is Bloomberg Technology.
News and Tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we can start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
The European Union today has passed the world's most extensive rules on artificial intelligence. Now, the landmark set of rules could set the tone for how AI is actually governed in more broadly the Western world. For more, let's bring in Bloomberg's Gillian Deutsch in Brussels. And many would say that some of the lawmakers have never been lobbied as hard as they have been over this particular AI Act. What's the takeaway for companies trying to build?
That's a great question. So right now it's a big celebratory day here in Brussels. I think last time I was speaking to you, it was after almost 40 hours of negotiations in mid-December. Fast forward, 3 months, and now we have the Parliament signing off on this act. And while it's a lot of celebration, we are getting lots of concerns, of course, from tech companies. They've been really sounding the alarm bells for quite some time about overregulation. Concerns that the European continent will be behind because they're regulating much more ahead than their U.S. Counterparts. We also have this concern, of course, from European tech companies too, and startups who say, "Hey, we really want to compete with U.S. hyperscalers, and you can't overregulate us. If you overregulate us, we'll never have a chance to actually compete."
Okay, I'm Mistral, and I am building large language models, and I'm based in Europe. Now that the act is passed, this is done, what is it that I actually have to do to comply?
So there are a few things. I mean, I guess it's good to look at the EU's approach as a risk-based approach. So for the most part, they're actually just regulating the use of the technology, not the technology itself. So this means that in practice, the EU will be banning, the worst possible misuses of AI. So AI systems cannot be used to, perform emotional recognition in workplaces or schools, cannot be used for social scoring, so giving citizens a score based on their behavior. When it comes to high-risk situations, though, these are some of the more tricky ones. This is, AI systems being used for migration applications or starting job applications. A lot of these companies like OpenAI or Mistral will have to perform a lot more checks in order to prove to regulators that they're safe. The one exception that a lot of companies like Mistral were really lobbying hard against were these additional controls to general purpose or generative AI. And these are not based on the use of AI, but this is explicitly regulating the technology itself. And in the end, what these companies will have to do is perform or kind of prove to regulators, their energy consumption, prove that they are actually complying with copyright laws. And there's a new AI office that will be based in Brussels and that the EU is currently setting up. This will actually kind of operate almost like a police force where they can go to the likes of Mistral, OpenAI, Microsoft, whomever, and say, hey, we want more data on how you've trained your large language model. And ultimately, they can even ban an application if it's performing poorly.
Gillian, Mistral has indeed partnered with Microsoft, and one expert saying that EU lawmakers, they've got played in this particular situation. Why will this not be a read across to just how the rest of the world adopts AI legislation?
I think it's really interesting because last year we saw lots of these tech companies even pushing for regulation. We had Sam Altman obviously in Congress, as everyone knows, pushing for regulation. And so we've had that obviously in Brussels, but while they've been arguing for regulation, they've also been simultaneously lobbying quite hard against some of the worst or strictest controls that they've seen in Brussels. Mistral was a really clear-cut case of that. Last year, they were really effective in getting the French government, also Aleph Alpha, a German startup, really pushing these governments saying, hey, if you overregulate us, then we will not be able to compete with US companies. Now, fast forward 4 or 5 months, they were obviously partnered with Microsoft. And so that's left a kind of a bad taste in a lot of lawmakers' mouths. But we also have lots of other companies that are really, signing on for voluntary commitments, trying to prove to governments they're taking this seriously, that they're taking as many commitments as possible. But I think more and more regulators are starting to wake up to that tech companies might be self-serving.
Huh. Never. Gillian Deutsch, we thank you so much. Ed, what have you got coming up?
The other top tech stories that we're watching in Talking Tech. First up, the Pentagon is pulling out of plans to spend as much as $2.5 billion on a chip grant to Intel. That's according to sources. The move threatens the total amount of federal funding that Intel was expecting to receive and now puts the onus on the Commerce Department to make up a shortfall. The funding was part of a package that allocated $3.5 billion to Intel to produce defense and intelligence-related semiconductors. Plus, shares of Singtel climbing the most in almost 2 years. This after the Australian Finance Review reported that Singtel was in discussions to sell off carrier Optus to PE firm Brookfield for $10.6 billion. Singapore's largest carrier responding to the report saying there was, quote, no impending deal to offload Optus for the said sum as reported. And Google is curbing its Gen AI chatbot Gemini from responding to questions directly to the Indian general elections. That's beginning next month. This follows similar controls it's set up in the US and other countries that are holding elections this year, all in this effort to combat concerns over misinformation and conspiracies. Google, meanwhile, collaborating with the Election Commission of India to enable easier discovery of vital voting information with Google Search.
Meanwhile, coming up, Ed, so much more in the world of tech to get to grips with. Chamath Palihapitiya's VC firm Social Capital firing 2 partners after a probe, citing an undisclosed situation. We'll have more on that next. Meanwhile, just check in on some publicly traded stocks right now. Completely flat on the day, but with a little bit of volatility is Eli Lilly. As the pharmaceutical giant has teamed up with Amazon to expand its wildly popular weight loss drugs directly to patients. Yesterday, actually, we sat down with the CEO of Eli Lilly, Dave Ricks. He discussed the direct-to-consumer innovations that they've been doing and also how they're tackling supply chain constraints for its GLP-1 drugs. Take a listen.
It's not a protein, it's chemistry, and it's not in that injectable device, which is so difficult to make. It's a pressed tablet. There's a lot of, the world is awash in those capacities. And so should the drug be successful, I think we'll be able to tap into quite a bit more supply, which will be good for the US, but even better for places like Brazil or Mexico or China.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Social Capital, the venture capital firm that's led by podcaster and former Facebook executive Chamath Palihapitiya, fired two of its partners, citing an undisclosed, quote, situation. That's according to a letter it sent to its investors that was reviewed by Bloomberg. I want to bring in Bloomberg's Mark Gurman, who broke this story. And actually, in the last hour, Mark, you've updated the story with more information, particularly about Ravi Tanuku, one of the partners terminated, because you've heard from his lawyer. Tell us the latest.
Yes. So yesterday morning, Chamath, as you mentioned, former Facebook executive, he's on the All In podcast, sent a letter to investors in Social Capital, to say that two of their top partners, Jay Zaveri and Ravi Tanuku, they were fired. They hired Wachtell Lipton, a big-time law firm, to review and probe the situation. And after a probe, Chamath terminated both of them on Sunday. The situation in question happened last Tuesday. And in the letter, all he did was call it a situation. So there's been a lot of intrigue within Social Capital, in the investment and venture capital communities about what exactly happened here. There's been all sorts of speculation, but now we've learned this comes down to Grok. It's an AI startup that Social Capital invested in, 5-6 years ago. And this had to do with the partners being involved in offering a special purpose vehicle related to Grok to some outside investors. This happened after, Grok was worth maybe 60 million a few years ago. Now its valuation topped $1 billion. So a special purpose vehicle related to that and all the money to be earned there. The company only said, Social Capital, that the two men violated company policy, but didn't go beyond that. And we've heard from lawyers for both of the men who were terminated saying there is no wrongdoing. And once they show their case, the public will know that they've done nothing wrong. And Chamath and Social Capital haven't responded to those responses.
Mr. Zaveri's firing was unfair and undeserved, so says the spokesman, and the firm's leadership approved and participated in the investment that is now being used as a pretext, they say, to fire him. Ultimately, Mark, how unusual is it to get such little information when such a step is taken? How unusual is it to lose such partners from a firm?
Oh, I mean, people are fired from firms all the time, but it is pretty unusual, especially you're showing the tweet from Social Capital. What they've done there by saying employee-specific circumstances and saying they have no further comments at this time, not even naming the people in the initial tweet, all they did was create a bunch of intrigue about what exactly happened. If they had come out and said initially what happened, maybe it wouldn't have been such a significant news cycle, but they handled this poorly from the get-go. And it was really a 3-sentence email from Chamath to a bunch of outside investment partners that really got this going. And in that email, all he did was call it a situation. He said, if you want more information, give me a call. So lots of intrigue here. So yes, an unusual situation indeed.
So Mark, Social Capital is basically not saying anything, giving any details, but we know this has something to do with AI startup Grok. Just explain the basics of that.
Yeah, I mean, there's a lot of speculation on what exactly that means, right? This AI startup, their valuation completely just went through the roof. And I guess there were some concerns from Chamath potentially about that investment and how that investment was handled and how outside investors had been dragged into that. We're still trying to gather more information on what exactly is happening here. Our hope is that the lawyers for both sides start presenting their cases to the public and perhaps send us more information about what's going on here so we can really understand. But this seems really abrupt, right? Having the quote-unquote situation appear on Tuesday, hiring a law firm on Thursday, having both partners terminated on Sunday, and then this announcement coming via email on Tuesday within 1 week. This seems like something that was done very quickly, something that may have been done in a rash manner. But really, we're going to need to know more information before we can really determine, who's in the right and who's in the wrong here.
And indeed, we have invited Chamath Palihapitiya onto the show and Social Capital to get a little bit more of that information. And I know, Mark, you have got plenty of queries out there with them. We thank you so much for breaking it all down. Mark Gurman, thus far, Social Capital has not responded. Coming up, we'll discuss all things crypto. Got to get back to it. With the market still trading higher, Tegan Klein is with us, CEO of Edge & Node. That's coming up next. Meanwhile, keep an eye on what's happening over with Disney at the moment because, well, the ongoing issues with certain investors, of course, trying to push back on Nelson Peltz in particular. But we see overall that this is a company that is looking to be responding overall. We see that Jamie Dimon, in fact, is backing Bob Iger in a proxy battle with Tryon. That's what's been coming out on CNBC a little bit earlier. But as far, we'll keep an eye on what's happening with Disney as the arguments continue over the direction of this company with what has been a very active investor, Mr. Nelson Peltz. Up 0.6%. This is Bloomberg Technology.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Technology. Ed Ludlow here in San Francisco.
Caroline Hyde in New York. Let's get you a quick check on these markets because, well, maybe a little bit of a sell the news after we take some profit on yesterday's gains. Once again, we're off about 0.8% when you're looking at the key benchmark that is the NASDAQ 100. So drawdown in particular when it comes to some of the key chip names, NVIDIA under pressure, Micron as well. So keep an eye on those chip stocks. I'm looking at the US, also perhaps dictating the path of trade for equities is what's happening in the bond market. When you see yields just pushing up a little bit on the end of the curve in particular, we've got a 30-year auction that's coming, and while there was a bit of lackluster demand yesterday, we could see a bit of pressure. Bond yields, of course, go higher. Quite often we see tech stocks go lower. We're seeing Bitcoin still managing to carve its own path. We're up more than 2% when you're looking at Bitcoin. We're up 72,761. Move on some of the individual movers when it comes to the tech names. And I'm looking, as I say, at the chip stocks. These have been pushing generally on the pressure of the NASDAQ. We're off by 2.6%. Tesla as well, seeing yet another day of losses, off by 2.7%. This as we see analysts once again going negative on the stock. And I'm showing some particular companies that are outperforming though. PDD, Chinese names, interestingly, on the higher side. No real catalyst for this. We had some mixed reviews coming from analysts at Monday's trade with, well, certain analysts saying like buy this stock, Goldman saying no, but we're up another almost 5% on the day, even as we continue to digest US-China tensions. And we're going to go back to that TikTok story in a moment. But now let's focus in a bit on what's happening with the crypto rally. I'm pleased to be welcome Tegan Klein, CEO of Edge & Node. It's a software development company behind the Graph, and actually an indexing and query protocol organizing the world's open blockchain data. And last time I checked, well, the crypto related to the Graph is seeing about a $4 billion market capitalization. Tegan, tell us about some of the exuberance, is it, or just natural interest that's coming into the space at the moment, given the ETFs that we saw launched? Will it stay? Is it sticky?
Absolutely. I do think it is sticky. Obviously, these markets are secular, so it won't be a straight shot up, but the total wealth in the world is $450 trillion, and I think Bitcoin will take at least 10% of that, if not more, over the next decade or two. So a lot of room to grow. I'm looking forward to it. The ETF, a lot of this was unexpected. The volumes that we've seen, over $1 billion yesterday came in inflows in just a day. So I think people were expecting tens of millions, and we're averaging hundreds of millions a day just in Bitcoin alone.
Tegan, as you run your business and you build out the technology, does it matter to you if Bitcoin is at $72,000 per token or $80,000 per token?
It doesn't. I don't really pay attention to price. We're here building. We've been through many bear markets, many bull markets, but it is exciting to see more people getting involved in this ecosystem. And crypto is definitely here to stay. The number of Americans holding crypto is only growing, and so I'm excited to see that continue.
One question we've not asked as much recently is whether the kind of negative overhang around your industry's gone away. We talked about how 2022, 2023, there was a bit of a black eye. A lot of it stemming from the collapse of FTX and what happened with Sam Bankman-Fried. Now we're focused on the trading activity of Bitcoin, the authorization of spot Bitcoin ETF. Is there some feel good in your world at the moment?
I would say, I think that it's important that we learn from the lessons of the past. When you look at things like FTX and the recent implosions, or the more recent implosions, a lot of that was when it comes to centralized tech on top of these decentralized ecosystems. And so it's really important that when you're thinking about crypto, especially in a world of an ETF, that you're self-custodying that crypto, because then you have true ownership over your assets. And it's really difficult to get that without self-custodying your assets.
The irony being, of course, with the introduction of ETFs, we're seeing a broader surge of people able to benefit from the gains, or indeed just broader volatility of Bitcoin, without having to go through the rigmarole of self-custodying. Tell us a little bit, therefore, about the underlying technology, what you're building, and ultimately whether any of this will be more than speculation. What is it that the infrastructure that's necessary now to actually be real rails, be a real alternative to normal finance?
Absolutely, yeah. So it's easy to kind of look at the screen and see these tokens and the trading volume and all of that. But when you look underneath the hood, a lot of these ecosystems, there's an ecosystem underneath. There's a thriving community of builders and individuals that are participating in these protocols. So when it comes to the Graph, we're organizing data. We're ensuring that data on the internet isn't corruptible. And last quarter alone, we saw 950 million queries, so almost 1 billion queries, and that's, you can think of that like a search. So Web3 usage is at an all-time high, and I think that's only going to continue. And when you look at crypto, you want to think about Web3 and you want to think about monetary policy. Bitcoin has very much proven monetary policy, and Web3 is something that we are currently building to decentralize the internet.
How global does that end up being? Where are the investors, the builders, the queriers to your sort of Google of Web3 coming from?
Great question. Yeah, so it is global. So there's a community of indexers, they're called, which are like nodes. They're almost Google-like companies, but they're all individual, and they're located all around the world, over many different continents. And so this is very much a global movement, and I think it's important that we remember that here in America. And I know London is thinking of an ETH ETN that is physically backed, and with that, we don't. In America, we don't want London to beat us to it, so I'm looking forward to the ETH ETF coming soon.
Of course, you particularly.
CEO. Oh, I'm sorry, Caroline.
Entirely my fault, Ed.
Tegan Klein, CEO of Edge and Node. What I was going to say, someone that came from the world of sort of traditional finance, London, Wall Street, and now in the world of Web3. Let's get another story. HiveMind Capital Partners is trying to bank on the latest crypto renaissance by betting on an NFT comeback. The firm is seeking to raise at least $50 million for a fund dedicated to digital art and blockchain. This after the firm already acquired prized NFTs from the portfolio of Starry Night Capital, an NFT fund launched by the disgraced founders of bankrupt crypto hedge fund 3 Arrows Capital. A lot going on in that world. More stories to come.
Meanwhile, we've got to get back to the top story when it comes to US, to policy, to regulation, all things TikTok. We're going to be bringing on a Republican representative. They're from Georgia. Buddy Carter joins us next. This is Bloomberg Technology.
You never hear people saying, I want my little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This plainly is a conduct law, meaning we're acting because of the demonstrated malign national security threat of TikTok, not because of the content of anybody's speech. And the bill is narrowly tailored, which is key for First Amendment analysis, because it simply requires divestment, meaning the millions of Americans that love TikTok, I'm not one of them, but they can continue to use the application, but just in a more secure way.
That was FCC Commissioner Brendan Carr before the House passed the bill that could lead to a sale or ban of TikTok in the United States. Let's bring in Bloomberg's Dan Flatley out in D.C. The House, as expected, passed the bill. It now goes to the Senate. For some, it's a foregone conclusion, but there is still some politicking to do on this in the Senate, Dan.
Yeah, absolutely. I'm standing here on the Senate side of the Capitol, just having come over from the House where there was a big vote, 352 to 65, in favor of doing this divestment or ban measure on TikTok. The question now, of course, is what happens over here in the Senate. We've gotten a little bit of an inkling over the last hour or so statement from the Intel Committee Chairman and Vice Chairman Mark Warner, a Democrat, and Marco Rubio, a Republican, saying they were encouraged by the House vote. They want to see this passed in the Senate. And then a statement from Senate Leader Schumer basically saying, we're going to look at it. So he hasn't committed to anything yet. The question is, what's the path forward? There's interest here, but we don't have a clear path yet.
Okay. Thus far, at the moment, is there a feeling that this could become a reality? We already know that, well, Shou Chew, the CEO of TikTok, has been up there already having closed-door meetings with senators, but also they're galvanizing their user base right now. You go on the TikTok app and they're wanting you to get in touch with your lawmakers.
Yeah, certainly a lot of lobbying and advocacy left to be done. I actually met with a couple of TikTok influencers here yesterday at the Capitol who were talking to members. What I've heard in the background from advisors and staffers here in the Senate is that let's see what the House does. Let's see what the House vote looks like. Obviously, we got a big positive signal for the sale or ban from the House today, so that could influence things. There's a receptive audience in the White House. President Joe Biden has said that he would sign this if Congress passes it. So you sort of have two of the three elements that you would need in order to get this into law. But the Senate does tend to work its own will on these kinds of things and to take its time. So that's still an open question. Obviously, TikTok is focusing its efforts on lobbying on the Senate, where they think that they can slow things down potentially.
We just showed some of what TikTok responded to the outcome of the House vote, and I'm sure we'll say it again, but they basically said the process was done in secret and the bill was jammed through for one reason. It's a ban, but on paper it's not a ban. It's a divest or ban bill. Is there any chatter about the process for a third party to come in and buy TikTok's US operations?
Yeah, it's interesting. You talk to a lot of members who opposed the House bill, and they say this just came together too fast. We have concerns, but 6 months, first of all, the bill came together to the House floor too fast, and then 6 months is not enough time to effectuate a sale. It just takes too long to do something like that. I've heard chatter about various groups coming forward and maybe potentially being interested, but there's no obvious purchaser for this. Companies have tried it in the past. There was a consortium between Walmart and Oracle and some others a few years ago that tried to buy it. It didn't happen. The company is much more valuable now. The company has said, TikTok has said, that it's going to fight this in the courts. So even if this were to get through Congress and be signed into law by the president, there's still going to be legal challenges, and whether they could get a sale done in 6 months is very much an open question.
Dan Flatley, plenty of questions still to be asked. We thank you so much, and let's ask a few more. We're pleased to have someone fresh from voting on the Hill, Republican Representative Buddy Carter of Georgia. And in fact, you're a co-sponsor of the bill. And I'm interested, therefore, with your perspective here, with it passing through the House, but former President Trump saying he actually is sort of backtracking, having originally been the first one with an executive order against TikTok. He now thinks if you pull away at TikTok, it makes Are the rivals more strong? Certainly Meta, for example. Are you still standing by the view that TikTok should be banned or sold?
Well, let's make sure we understand now. We're not talking about banning TikTok. This is up to TikTok. This is up to ByteDance. They make the decision on whether they want it to go away or whether they want to divest themselves of the ownership of this. This is two questions here. First of all, this is a question about, is it going to be banned? No. They have to divest themselves. That's a question that only they can answer. The second question is us in Congress, us in the House and in the Senate, and that is, this is about national security. Now, are we going to take national security seriously? The number one responsibility of the federal government is to protect our homeland and protect our citizens. We have to take it seriously, and it is about national security.
Congressman, thank you for your time this morning. Project Texas was the plan whereby the US user data of the TikTok app would be housed in data centers onshore here in the United States, owned and operated by Oracle. Were you not convinced of that plan such that you co-sponsored this bill? Why did that not work?
No, it doesn't matter where they are based. If it's owned by the Chinese Communist Party, that's the problem. And that's the responsibility of Congress. That's our responsibility to guard against these kind of national security issues. That's why we acted on this. And I would beg to differ with some of my colleagues who are saying, oh, this was too rushed, this was too rushed. We've been talking about this for a long time now. And remember, TikTok has been banned on government phones for some time now. So this is not anything new. And again, this is not a ban. We're just saying that ByteDance, the parent company of TikTok that is owned by the Chinese Communist Party, they must divest themselves of this. And the bill specifically says adversarial countries. I mean, we're not talking
Congressman,
about it.
Congressman, I'm sorry to interrupt you, but there is a choice on ByteDance and TikTok side as well. It's a divest or ban, and Bloomberg's reported that TikTok will exhaust its legal options to avoid a sale or a divestiture. There are 170 million Americans who love using TikTok. What do you think is fair in the case where TikTok just says, we're going to dig in here, we will not sell to a third party?
Well, if they're not going to sell to a third party and they're just going to continue to be used by the Chinese Communist Party, then I think that we have to step in and we have to say, no, you're not going to be allowed here. You know that American apps are not allowed in China. I hope everybody realizes that. And you know that the content of TikTok in China is different than the content of TikTok here in America. You know, we're not just talking about dancing people or cats or being on TikTok. We're talking about the ability of the Chinese Communist Party to get your data, to actually use biometrics against you. And that's something that we have the responsibility in Congress of guarding against. If we don't do this, then we're being irresponsible in Congress.
What's interesting is if indeed ByteDance is sold, that impacts those that have invested in ByteDance, the parent of TikTok. One is actually, well, a billionaire GOP mega donor. Jeffrey Yass being one of them, $15 billion riding on his investment. And of course, he made his fortune with Susquehanna International Group. How are you talking to some of the people who have a lot of money on the line when it comes to their investment in TikTok?
Again, if they don't want to lose their money, and I certainly don't blame them, I wouldn't want them to lose my money either. But a divestiture means that they're not going to lose their money. It just means that it's not going to be owned by the Chinese Communist Party. And when you take the chance of investing in something that is owned by the Chinese Communist Party, then those are the chances you're taking.
Have you spoken to Jeff Yass out of interest?
No, I have not.
All right, Republican Representative of Georgia, Buddy Carter, we appreciate you joining us almost immediately after the outcome of that House vote. Now, coming up here on Bloomberg Technology, we're going to hear from former San Francisco mayor, who's currently a mayoral candidate, Mark Farrell. He's seeking to revitalize San Francisco with a new package of proposals that are very aligned with technology. We'll discuss that next. This is Bloomberg Technology.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Venture capitalist Mark Farrell, a leading contender for San Francisco mayor, unveiled a package of proposals that include providing more money to the police and restricting access to public parks as he hopes to boost public safety, revitalizing downtown SF and revamping the city's image. But we also talked about technology and what he'll do to incentivize the industry. Have a listen.
I'm fortunate to already have support from diverse communities across San Francisco. In every single neighborhood, every single economic makeup of a family, every single business that you could imagine and career that you could imagine. So I believe my private sector background matters. And you asked that question before. In particular, over the next 4 years, when we have a projected $1.5 billion budget deficit in the city of San Francisco, having a mayor who's actually read a P&L, knows what a balance sheet looks like, and has been in that sector for over 20 years matters to the city of San Francisco. We cannot afford to have somebody come in and learn on the job, or we can't afford 4 more years of the same administration where you're simply listening to other people tell you where to put your dollars. We need a mayor who's going to lead on the budget and be strong with his or her priorities, and that's what I offer San Francisco.
Okay, so let's talk about technology. Technology as a business, as a taxpayer in this city. How are you going to approach the biggest employers, the employers also of a lot of people that live in this city but might commute outwards to Silicon Valley?
What San Francisco will have in me next year as mayor is finally a mayor that once again addresses and actively engages with our business community. Technologies have been a big part of it here in San Francisco, quite frankly, for the past 10 plus years. We've been over-indexed to the technology sector here in San Francisco, and we need to make sure we actively court that industry to come back to the city of San Francisco, because technology companies have left in droves. But I also believe it's the impetus of the next mayor to diversify our downtown economy. Once again, focus on hospitality. Once again, focus on residential.
My conversation with Mark Farrell, Karen, he was somebody who was interim mayor in 2018 after the death of Ed Lee. He was late to the race, but you look at how quickly he's raising funds to catch up and where the funds are coming from, and that's the technology story for me.
I mean, you've deep dived so much into areas and pockets of growth in particular, rejuvenation that AI in particular has brought the area. Cerebral Valley, for example, your documentary of late. I mean, this is someone who's got to be seeing the opportunities as well as some of the things he still wants to be fixing.
He wants to offer tax incentives to tech companies that make in-office mandatory and also that scrap in-office cafeterias so they go spend in the local economy. So he recognizes the AI boom that's happening, but I don't know how popular mandatory in-office is going to be in this this city. It's hard to call.
It's getting a little bit more popular coming from some of the C-suite levels, though, of late. Meanwhile, talking of C-suite, we know that one person has been busy. And, of course, Shou Chew, the CEO of TikTok, has been busy on the Hill talking to senators, we understand, as we look to potentially a ban or divestment of TikTok from ByteDance being pushed through by the House. It really did sail through that vote earlier today. The question mark here is what happens with the Senate, and we just heard from one key lawmaker there.
Yeah, and his point that really stuck out to me was, well, if TikTok chooses not to divest, we'll make them.
Yeah.
But this was supposed to be a divest or ban bill.
And look, this is very deja vu. This was happening in prior administration with a prior decision and push to have them divest, and well, people being lined up then. And Oracle was one of them, and Oracle became, well, the data answer that doesn't seem to be living up to many hopes right now for some of those lawmakers. That does it for this edition of Bloomberg Technology. What a big one we had.
Yeah, and in some ways a historic show. Recap everything that was discussed on the podcast. We're on Apple, Spotify, iHeart, and so many of you are listening to the podcast on a daily basis on the Bloomberg platforms. Thank you so much. From San Francisco and New York City, this is Bloomberg Technology.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we can start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Welcome to Bloomberg Markets. I'm Shonali Basak. Equities are struggling to gain traction after a rally that has defied every doomsday scenario on Wall Street. Let's get a quick check on the markets here because the S&P 500 now lower on the day. The NASDAQ 100 following suit as well. The S&P 500 down almost 0.1%, looking like it could end flat on the day. Let's take a look and see where that goes on the day. We are off session lows. NASDAQ 100 also down still more than 0.7%. We are looking at movement in yields as well. It's not a whole lot from yesterday. Remember, we're only about 2 basis points higher, but we are at levels above 460 once again, where we started last week. And the 10-year yield now at 418, a 3 basis point move higher. And again, much more economic data ahead this week before the FOMC next week. Now let's talk about some midday movers on the equity side, looking at some of the biggest losers in the S&P 500. Nvidia, Apple, Tesla, all dragging the index lower. Dollar Tree shares are having their worst day in nearly a year after announcing plans to shutter about 1,000 stores in an effort to improve profitability. And Valero Energy, it continues to rise actually after hitting a record high just yesterday, with energy the best performing sector in the S&P 500 today. Now, when it comes to the macro outlook and the Fed, earlier today, former New York Fed President Bill Dudley gave us his take on where the rate path goes from here.
March is off the table. May is probably off the table too. We're really talking about what, Fed cutting rates probably sometime this summer. I would guess the median will be 3 again this time, but there's some possibility given the firmness in the inflation data that maybe those are only going to be, the median's going to shrink to 2. But I bet they keep where they were last time. There's still plenty of time, still plenty of meetings this year to cut rates 3 times.
Now, Citadel's Ken Griffin also spoke this week about the Fed, and it said the bank needs to be more careful. At a conference, Griffin said that pausing and then changing direction back towards higher rates quickly, that would, in my opinion, be the most devastating course of action to pursue. So I think they're going to be a bit slower than people were expecting. And we're going to discuss this all now with FS Investments chief economist Lara Rame, because Lara, you were pretty early here to say inflation could have a sticky path lower. It could potentially stay a little higher for longer. We've seen 2 months of data kind of upsetting the course here. But do you think that it could get worse in terms of the inflation story moving forward?
I don't think it has to get worse. I think what we're experiencing is really familiar. It's that whack-a-mole, right? Every month, it's like the data look great, but there's this one-off factor that caused the upside surprise. And this is what we keep hearing. And you know what? That is the 3% inflation backdrop, not a 2% inflation backdrop. And that's the problem. I think that's what the Fed is going to have to wrestle with. I think it's going to be a lot harder for them to cut rates than markets currently anticipate.
When you say much harder, do you mean beyond that first rate cut expected, or do you think that even first rate cut would be difficult?
I think they're going to have to wait until, I would actually estimate, deeper into the third quarter than June. And I really use this phrase specifically. It's surgical rate cuts. I think markets need to move away from this idea that there's going to be like an easing program where we're cutting on a regular basis. It's going to be a nip and a tuck, and it's going to have to be carefully snuck in between markets that are still racing higher today, notwithstanding, and data that across the board look really strong.
How do you think about the data ahead? We had some critical data already yesterday when it came to the inflation print, and we are drumbeating now to that large FOMC meeting next week. What are you looking out for?
I think in retail sales are going to, as always, be really important. But beyond that, I think the employment picture still looks really solid. I think I'm also looking at business investment. We are really seeing an economy firing on all cylinders, but the last 2 quarters, business investment has slowed a little bit. I expect it to stay really positive. But I think, as we look ahead, the economy just remains strong. It's really about inflation. And I think, at the margin, when we look at the consumer, some of the delinquency numbers really bear watching. I think spending, we're going to get another month of solid consumption.
When you think about what we've seen in the yield curve here, the longest inversion on record, when we look at the 2-10s curves in particular, what is that telling you? Are you still worried that perhaps we haven't baked in what's worse to come when you think about a landing?
I think you bring up an important point that is not discussed enough. This yield curve inversion may not be as reliable of a signal of recession, but if we think the economy is going to stay robust and not move into recession, that yield curve has got to renormalize. I think it's a combination of a couple of rate cuts in the second half of the year and long-term rates moving higher. I think we retest 5% on the 10-year sometime this year, but I'm not sure it's going to have the same consequence that the rapid move in the third quarter of last year had on broader markets.
Now, how do you think about this issue here? You kind of mentioned this idea about inflation being supported around the 3% level. Do you think that means rates stay high for longer? And what does this mean for you in terms of the discussion about what the true neutral rate really might be?
I'm moving away from this concept of higher for longer because I see it as a renormalization back to the 1990s and the early 2000s. I think we got complacent that rates should somehow be so low. Even if the neutral rate stays where I think long run estimates are between 2 to 3%, and I know that's a wide band, but we really need to have that in the back of our mind because I think there's a lot of uncertainty around those estimates. That is a world where interest rates could easily come to rest with the Fed funds rates between 3 and 4%, and long-term rates could be around 5%. That may sound bearish, but actually for asset allocators, that's a rich environment with a lot of potential ways to diversify away from traditional assets.
We'll expand on that. In that kind of environment where long-term rates shift towards 5%, that's obviously higher than we are right now. Where do you see investments going?
The good news about a solid fundamental backdrop is that private credit, high yield, private equities really offer a robust opportunity for double-digit returns. I think the good news is we're kind of out of that like Tina era. Like there is no alternative but equities. Now, if you even think equities are going to go up 10 or 15% over the year, and I'm not an equity analyst, but you can counterweight that with real opportunity in your portfolio for other double-digit returns. And I think that's important. You know, we see so much concentration in the Mag 7. You want to diversify and balance that in your portfolio. And for an asset allocator, it's finally some good news. There are great alternative ways to do that.
Well, it's interesting to think about private credit in that environment because if you believe that longer term rates are going to normalize, they'll still be higher than potentially what we're seeing now. And do you see companies start to struggle a little more than they have been in that kind of environment?
I think, you know, we're clearly going to see one or select companies that have been kept afloat by artificially low interest rates bear some of the difficulty. But I think what has been the problem with higher interest rates is that we moved there so fast. I think now that we're in a world of higher interest rates, I compare it to someone moving from San Francisco to Chicago. The first winter's horrible. The second winter, you're like, okay, now it's a little chilly, but I'm getting used to it. And by the third winter, you understand that this is what winter is. It's all a long way of saying that with higher interest rates, the longer that we are here, the more companies will build this into their financing costs and the more that markets, even households, will manage through it.
FS Investments Chief Economist Lara Rain, we thank you so much for this week as we see yields drift higher, at least for the week. Now we're going to go from the Treasury market to the rest of the bond market because the implied cost of refinancing junk bonds is now at its lowest since May of 2022. And those falling costs have spurred a wave of corporate bond sales, and they've pushed back that maturity wall of debt coming due. Bloomberg's Tassos Vassas reported on this from London. He joins us now. It's one of the most read stories of the day. Tassos, how do you think about this maturity wall and why it's finally coming down?
Well, the maturity wall is usually not a problem if companies can, for example, raise new debt in order to refinance that. And that wasn't a problem at all in the decade leading to 2022. Now, as everyone knows, what changed then is that central banks started jacking up rates in order to tackle runaway inflation. So at that point, we had the problem, and that spurred concerns among the investors. If companies have to repay a large amount of their debt in a short period of time, Are they able to raise new debts at acceptable levels? Back in 2022, that wasn't the case. And we're concerned that when we make it to 2023, 2024, 2025 even, then some companies will have trouble and big trouble repaying their debts. That has started to change now. As you said before, refinancing costs are decreasing. That allows the wave of debt that we're seeing, and the maturity wall is being pushed back to 2025, 2026.
Tassos, how do you see the problems that could still lie ahead? On one hand, you have rates being pushed a little lower by the market. It's helping out some of these companies that would have otherwise refinanced at higher rates. But what could still happen from here?
Well, the market, everything's falling into place in the credit market in order to create this kind of equilibrium that allowed the companies to come and issue at relatively cheap rates. The problem is that we are pricing in a scenario of even no landing, if soft landing, and we have inflows to credit funds on the back of relatively high interest rates still. So if one of these things changes and the Fed, for example, doesn't cut when we expect them and by the amount we expect them, if there is some kind of landing and if fund flows start becoming lower or softer than we have right now, then the situation could be rather fragile.
Tassos, we appreciate your time and your reporting. Take an eye on his story on the terminal today about this bond rush that is Bloomberg Tassos Fassos. Now, coming up next, we're going to talk to Ilan Rosen of Oppenheimer on why the options market is showing you signs of stress and signs of opportunity. We're going to talk about why he's keen on one certain sector in particular this year. Stick with us. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, well, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
This is Bloomberg Markets. I'm Sonali Basak, and it's no secret that markets have rallied in a massive way out of the October lows. Nvidia, Bitcoin have been big drivers of that risk-on sentiment, but what's less known is what's next for stocks and other assets. And to parse out the details, we're going to bring in Ilan Rosen. He's the head of institutional equity derivatives at Oppenheimer, and Bloomberg's Abigail Doolittle. Ilan, when you look at the risk-on appetite that has been pervasive across Wall Street, do you worry here at all that things are getting a bit toppy, that some trades look a little crowded, and if anything were to back off from that moment, that it could have a bigger impact here?
Hi, Sonali. Great to see you, Abigail, as well. So it's been all about NVIDIA. It's been the driver of the market. A lot of correlations to Bitcoin. If you look at those two charts, they've been going hand in hand on this meteoric rise. And I think what we've seen is a little bit of euphoria hit last Friday. There's a lot of questions on why the strong reversal, and it was nothing fundamental. We're hitting a lot of technicals here in this market. Liquidity has been driving it. Investors are taking money out of cash and have been putting it to the market finally, even at highs here. And what we saw was the relative strength index was very notable. The RSI hit an incredible 83, a weekly RSI over 90. This is on NVIDIA on Friday. So this is massively above the 200-day. These are levels that have been unheard of, that not even Cisco back in first quarter of 2000 when it hit its highs even saw close to. So we've kind of seen a little bit of a too crowded situation. The call option volume was massive, and that's just what led to a complete collapse and kind of a rug pull in that matter across the semi sector. But right now we are seeing general risk on. Eco data, whether it's good or bad, is being interpreted positively. Looking at yesterday's CPI, it's been a factor of, okay, if it's hotter, then maybe they'll cut rates sooner. If it's cooler, then that's positive and inflation is going lower. So it's been challenging to see what exactly might cause this market to go risk off. And we've been focused on more underperforming sectors on our desk. Specific. Sorry.
No. Great to chat with you, Alon. And let's talk just a little bit more about NVIDIA, because you could really substitute the word NVIDIA for market rally, whether it is the October 2023 or 2022 low. That stock up more than 600% over roughly, let's call it a year and a half or so. So you were saying that it is a little bit crowded. I'm looking at the technicals here, and it looks as though the RSI on a daily basis, lower highs, less momentum, weaker hands buying in the recent highs. So if NVIDIA, this consolidation, were to turn into something more like, I don't want to call it a crash, but a correction, would that be, would that just pull the rug out beneath the markets?
Yeah, 100%. I think we got a taste of that on Friday when you did see a big reversal in the market. Once NVIDIA turned, it felt like it might have had to see 1,000 first just to catch that big round number, but it stopped at around 975 before the rug pull. And I do, it does feel like as NVIDIA goes, so goes the market. But, in general, we are seeing even a day like today where NVIDIA is maybe a little weaker and tech's being sold, we're seeing other pockets of strength in the market. But, if you look at fundamentals of NVIDIA, and not my territory, but many people still think it's cheap and can think it goes up 2-3 times from here. So there's a lot of a big battleground on where it should trade. On the flip side, bears feel that it's getting a little too crowded from what they're able to add versus the potential competition ahead. There's a whole thesis on the bears, but even the bears are scared to step in front of this freight train for now.
You just mentioned the rotation that we're seeing today. So what if we were to see, why wouldn't a potential rotation into other sectors or other styles, small cap, why would that not save the markets from NVIDIA? It's not the top or even the second top weighting for the S&P 500 or the NASDAQ.
Yeah, no, I do think right now that the general trend, Opco's Ari Wald has been phenomenal with his market call. He's our technical strategist. He continues to think, anything under S&P 5400 is cheap. So, we're seeing investors look for value outside of technology. It does feel a bit of a chase here, but from what we saw Friday was a good taste of that potential risk off. But every dip we've had, it's been a one-day wonder. We've gone right back up. So it's been challenging to think that we should just go straight down. And, we've been saying for the last month and a half, quote unquote, if you're not long, you're short, because you are underperforming if you don't have long stock exposure across different areas right now. So we're promoting to stay long, keep your long exposures, but we are entering a more seasonal period ahead, a little more choppy. So we are using ETFs again to start adding downside protection. And if investors are short stock or short futures in S&P and NASDAQ, we do think it's a good time to use the cheap implied volatilities to add convexity to that portfolio using options as part of your hedges.
Well, you mentioned a little earlier, Alon, that you were looking outside of those big tech names to add some value. Investors are starting to do more of that. But how do you define what that means?
Yeah, so if you look at IWM, the Russell 2000, that's trying to break out of its current range. 207 is a big level. We're kind of right up against that. You look at a sector like China, that's become uninvestable as of late. Nobody's long it. It's been extremely frustrating year to date, and that's also trying to break out of its recent range. We actually had a very active K-Web trade on our desk today. We traded around 320,000 contracts where we sold the March 27 calls and bought the May 28-33 call spread around 80,000 times, which was a notable print earlier, and it just goes to show that people are looking for those catch-up plays. They look at U.S., they look at U.S. tech. Why can't China catch up to that a little more than it has? So we're seeing people kind of try to find value. Biotech has been a big area and focus for Oppenheimer. We've had a great call out of Oppenheimer's research team, specifically Viking. It's an outperform name, $116 price target, VKTX. It's had a massive move from as low as 10 to almost 100, and it came back to around 63 a couple days ago, and we're back pitching that long. We do think that has good upside into its data at the end of the month. So I do think biotech, financials, energy, China, we could see where money rotates out of tech into those areas for further upside.
Alon, we thank you so much for your time. That is Alon Rosen. He is the head of derivatives at Oppenheimer Equity Derivatives, and Bloomberg's own Abigail Doolittle. Now coming up, quants. They're having their best year since 2008 with 45% gains. Of course, that's way better than most of the hedge fund industry these days. We're going to talk about those details next. This is Bloomberg.
Regional sports networks. There's a lot, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg Markets, and I'm Sonali Basak. Trend-following quants are rallying back on Wall Street, and they're having their best year since 2008. That's the start to the year, and it's thanks to that relentless stock market gain and sharp moves across commodities. Bloomberg's Denisa Sekova reported on this and joins me now. One of my favorite stories out on the terminal right now. I always like to say I was very much a failed quant, and so to see them succeeding, it's been a while. It's been a rough couple of years. What's driving the quant complex back?
Yeah, so last year was actually a pretty tough one. And this February, they're having the second best month on record for many of those big names we mentioned. We mentioned AQR, we mentioned Bund Capital, we mentioned Mulvaney. It's a big part is equities. The game in equities has been momentum. So those quants who actually chase trends, they don't really care about fundamentals. They care only about the price. They've been doing amazingly well. And then in commodities, there have been a lot of more niche markets like sugar or just soybeans that have been doing that have had very specific trends. So following them has been a really big driver of the returns as well.
Well, it's interesting. You wrote that AQR had its second best month on record in February for at least 3 trend-following strategies. What about the others? Talk about Mulvaney and some of these other funds for a moment here that may not be as large as AQR.
Yeah, they're for sure smaller than AQR. They also had the second best month for each of them, the best month since 2008. So you can imagine it's another period of very high volatility when they managed to succeed. This time for them, actually commodities is a slightly slightly bigger driver than equities. We saw some of the biggest durations in like 20 years in some of the soft commodities. So riding those trends has been very beneficial for them. They've had a somewhat strong January as well. So some of the gains we're seeing year to date is like 30, 45%. So really incredible start of the year compared to what we're seeing from all other markets.
How do you think about these returns moving forward? Is there something that can throw things off, especially when there's that kind of underlying critique in the market that perhaps it's these CTAs, these trend followers that are exacerbating the market moves in the first place?
Yeah, so this is an interesting environment for trend following. People are saying that trend followers are doing very well when stocks are down by a lot and when stocks are up by a lot. So you can argue if this strong momentum trends continue, they can continue to do well. Whether they exacerbate the moves, obviously that's been a big debate. I would say it's very divided on Wall Street. We have seen numerous occasions that maybe they have had some impact, but more broadly, a lot of the quants are really shutting that thesis that they are responsible to those big moves. But you can imagine in a small market like sugar, having a big position there potentially can have some sizable moves.
What are you watching next here? If you think about moving forward here, and really quickly in about 30 seconds here, is it the commodity market or the equity market to be watching for these guys?
I think commodity market is a very interesting one. It can continue to show big gains because the way those strategies thrive is they need macro uncertainty, inflation uncertainty. So this is a market that we know is very sensitive to that.
Danitza, we thank you so very much for your time here, following those quants around, especially because many of them are computers. Very, very, very impressive. Now, before we let you go, take a quick check on the markets before we head to break here, because we are still watching some red on the screen here. We're watching the S&P 500 still down less than 0.1%, but still down on the day. The NASDAQ 100 also down still more than 0.7%. Yields still on the rise. 460 on the 2-year, 418 holding strong on the 10-year. Again, more macroeconomic data ahead this week, and a lot of stalling out before we head into the FOMC meeting next week. Coming up, we're going to talk to Searchlight Capital about the private equity industry. Stick with us. This is Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Markets, and I'm Shonali Basak. We've been talking about how equities struggling to gain traction today. We are 1 week away from the Fed's next rate decision, and you are watching a lot of uncertainty seep into those markets. Getting a check on those markets, we're still seeing a lot of red on the screen here. S&P 500 down now more than 0.1%. The NASDAQ 100 down nearly 0.8%. That two-year yield has been about stable. Even though you're seeing that 2 basis point move on the day, we did see a bulk of that move yesterday when we saw that inflation print. So holding at just under 461. The 10-year yield also holding strong throughout the day, 3 basis points higher at about 418. Now, some midday movers here on the equity side here, we're watching shares of social media stocks after the House passed a bill to ban TikTok in the United States unless its Chinese owner sells the video sharing app. The bill now faces a less certain future in the Senate, which oppositions are faced on both sides of the aisle. Now, we're also watching Bitcoin here for the fresh all-time high for the 4th time in 6 days. And net inflows yesterday topped $1 billion for the spot Bitcoin ETFs. Coinbase rising even more after JMP Securities raised the price target on the cryptocurrency platform to a street high of $300 per share. Now, one stock that got a pop this week was Paramount on a report that Apollo reached out to the company about a possible takeover of the asset purchase. And just this Monday, we heard from a large shareholder of Paramount, John Rogers, who spoke about a potential deal.
There are so many large technology companies as well as traditional media companies it would be natural to want to buy Paramount Global. And you can get it for such a, we think it's really selling at a significant undervaluation here. And there's so much negativity around it. Everyone hates it. And you remember the great John Templeton always used to say you want to buy when there's maximum pessimism.
Now, there's another media deal that Bloomberg has reported on recently, that is Charter Communications exploring a takeover of Altice USA. And while the Charter CEO didn't comment on that report, he did certainly say he likes the idea of Cable M&A more generally. There's a lot of talk when it comes to deal making throughout the industry, and we're going to bring in Eric Zinterhofer, who is a founding partner of Searchlight and non-executive chairman of Charter. Eric, you look at this industry, you're finally seeing some life breathed back into it. How likely are large-scale mergers in this industry, particularly with the support of private equity?
Well, Shonali, thanks for having me on. As we just talked about earlier, it's hard for me to comment on these things. I'm chairman of Charter. My alma mater is Apollo. I know a lot of the folks there well. We're big shareholders in Televisa Univision, where Wade Davis, who's the CEO, used to be one of the most senior executives at Paramount. So needless to say, I'm close to a lot of people in this world and won't be commenting on any details related to M&A. What I will say, broadly speaking, is that the prerequisite to the kind of large-scale M&A that you're referring to, big strategics, coming together with big strategics, really predicated on 2 things. One is the regulatory environment changing, and then the other is operational excellence. If you think about the traditional media companies, they need to prove out this transition to streaming. They need to prove out that the traditional ecosystem can be rebuilt in a healthy way. And as you may know, Charter is trying to do that, and we're trying to help along those fronts. When that happens, I do think you're going to see larger scale strategic M&A. In the interim, I think smart private equity players can anticipate that, and identify companies that are moving in that direction and, potentially make some good investments.
Well, talk more about those investments. If you're looking at these massive shifts across TMT or other industries, from where you're sitting, there's still a private equity industry out there with tons of dry powder, but the cost of financing is higher.
Yeah.
Even if it goes down a little this year, it's still higher.
Yeah.
So how does the math start to work here?
Well, the way it works is the market's a little bit bifurcated right now. Equity markets that are all-time highs. On the other hand, people are kind of either AI-focused or private credit-focused, it seems, in their skew, at least among big allocators. There's a big middle, in my opinion, that's being ignored. There's a lot of public companies out there, particularly if you're less than $1 billion in market cap, where your valuations are much less than the larger companies. It's expensive to be public. You're illiquid. And I think that's where the opportunity lies for private equity. Those companies don't want to be public anymore.
Well, those companies also, and whether you're in that kind of big cap moment or if you're in that kind of less than $1 billion area, there's a lot of questions about what your existing debt load looks like.
Yeah.
And if you're looking at a company potentially looking to take it over, how do you feel about companies that are still saddled with potentially too much debt?
You're right. The other dynamic going on right now is that we're in an era of deleveraging. Despite these buoyant markets, these capital structures were set up in zero interest rate environments. So if debt as a multiple of EBITDA, let's say, is about 6 times, which is about the average of a lot of these more leveraged companies, it needs to come down to 4. And the way to do that is to have a deleveraging skill set as an investor. And this is something we really focus on. So, the concept is in an industry you know well, where you can really add value, go to that company and say, you know what, we'll come in with a security that still provides real upside to the equity, but actually deleverages the company enough so that they can play offense. And you need that skill set in this deleveraging era that we're in.
When you say that skill set, you've seen a lot of your rivals in the private equity community really push into private credit, either in addition to what they're doing or even instead in some cases. Do you think that that's almost an overcrowded space at this point? How do you keep chasing returns in a space like that when the banks are also stepping back in?
I think what Apollo's doing, what Ares is doing, and others is really interesting, and I think it's very positive for the economy. You're basically taking, leveraged bank balance sheets that are prone to dislocations and moving all of that private credit to less leveraged balance sheets at scale, I think, which will provide great credit and be a boon to companies over the next 10 years. That being said, those firms are vacating a lot of the equity spaces that are still very necessary as a result of really pushing into this credit realm. And I think that creates opportunities for kind of more creative equity players that can play across the capital structure.
Does that mean for you, you double down on the business of private equity?
Yeah.
And so you were talking about these deals that are under $1 billion that are looking attractive to you right now. You look at where the herd is going. You look at valuations in AI and in other industries, and do you start to go where others are not? What does that look like to do?
Yeah, we've always been doing that. For us, it's about transforming businesses. And you can take great traditional businesses and transform them into something special that can excite investors with growth. We took a business called Shift4 public. It's now a public company. Jared Isaacman's still the CEO. He was the founder. We partnered with him to do that. It was an incredibly successful company. It resulted in him leading the first mission to space and financing it, which is an amazing story in and of itself. But we turned that from a traditional payments business to really a software business and a very high growth business. We're doing that with Televisa Univision. This was a traditional broadcaster. It's now vertically integrated. It's the biggest content producer for Hispanics on the planet. There's 600 million plus Spanish speakers. And we've built a streaming platform from scratch, which will be profitable this year and is growing very rapidly. Those are the kinds of transformations you can do with traditional businesses as opposed to buying the perfect high growth business at a too high valuation.
How do you feel about an exit opportunity here for the companies that you own currently? Do you think that there's a window here to take advantage of with the IPO market? Does it look attractive to you? And do you think it lasts?
I think for the right companies, you can do it. If you bought them well enough, you don't need a crazy multiple to sell them. And we do a lot in infrastructure. We're like the 4th largest builder of fiber, I think, in the United States across our various companies. That's a very hot area. Obviously, there's a lot of public-private partnerships to do there, with all of this infrastructure money coming in. So I think there'll be opportunities, for exits in those kinds of areas.
Really quickly here, the next 12 months, how much do you think deal making actually ticks up, and how much are you willing to start putting to work? We're willing to do both. I think we're kind of balanced between buying and selling right now. We were like that last year, which was kind of a tricky year. We are like that this year. We've made 4 investments already in our recent funds. So I feel pretty good about the investment environment, particularly to help companies deleverage. That's really where we've been focused. Eric, we thank you so much for giving us a little look under the hood in the deal environment right now. That is Eric Zinterhofer, founding partner of Searchlight and non-executive chairman of Charter. Now coming up, we are looking at United Health because it faces a class action lawsuit over its retirement plan. And remember, now cancer clinics across the country are reeling from a cyber attack on the health insurer just last month. We'll talk about that next. Stick with us. This is Bloomberg.
Let me ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. Do you ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money
as of now. 38 points, up 0.3% with the Dow at 39,142. We've got the S&P up barely, up by 2 points right now. A little change. NASDAQ in the red, down 41. A drop there of 0.3%. The NASDAQ 100 index down 0.5. Tough day for a lot of big technology names. 10-year yield 4.18% with a 2-year 4.61%. Spot gold is up 0.8%. 21.74 the ounce. West Texas Intermediate crude oil up 2.4%, 79.44 a barrel, and Bitcoin right now up 2.7%, 72,950 on Bitcoin. Wall Street stance on Tesla worsened further today as yet another analyst warned about risks to sales and said its strategy of cutting prices to boost demand was losing its effectiveness. Wells Fargo analyst Colin Langan called Tesla a growth company with no growth. Tesla down 3.7%. Recapping stocks trading mixed. S&P right now up by about 0.9, up by just about 1 point. Little change there, up by less than 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Which of course begs the question, can you be a growth company without growth? But I'll leave that up to smarter people than me.
That's for investors to decide.
I'll leave that to AI to figure out. All right, first up, we've got two stories, both with the U.S. policy aspect. We've been talking about it all day long here at Bloomberg, both involving companies in the tech space. We're talking about TikTok and Intel. Let's get to Intel first. Intel, along with the overall semiconductor space, trading lower. You've got Intel down about 3.7%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down about 2.25%. News in the space, Tim, as we know, coming after the close yesterday.
Yeah, look at this. The Pentagon pulling out of a plan to spend as much as $2.5 billion on a chip grant to Intel. That's according to people familiar with the situation. That puts the onus on another federal agency, the Commerce Department, to make up for the shortfall.
All right, with us to explain and get to the impact, Bloomberg News U.S. semiconductor and networking reporter Ian King joining us from our San Francisco bureau. Also with us, Mackenzie Hawkins, who follows U.S. industrial policy, in particular the semi space, at Bloomberg News. She is joining us from Washington, D.C. at our Bloomberg News bureau there. Hey guys, thanks so much for being with Tim and me. Mackenzie, first up, I just want to start with you. TikTok news, the money for Intel. What can you tell us about the general mood among U.S. lawmakers when it comes to U.S. industrial policy and moving these things along? Because they seem to be moving at a fairly rapid pace.
Well, we're actually about 18 months out from when Biden first signed the CHIPS Act into law. That's this landmark semiconductor subsidy program that's meant to bring back production of semiconductors from Asia to America. And lawmakers and companies are saying, where's the money? You know, we've seen a couple of grants go out the door so far. Those are for companies that make older generation semiconductors, but we're still waiting for announcements for firms at the cutting edge, including Intel. Intel's announcement was actually supposed to be a couple weeks ago before this whole Pentagon thing went down that we're about to chat about. But there is a lot of stress and anxiety in Washington about when is this actually going to start happening, especially as other countries plow ahead with their own programs.
Okay, Mackenzie, so let's talk about that grant for Intel, the news. What do we know, in terms of where this money is going, where this money came from, and where the money's not going to go at this point? I mean, is this just moving money around on the balance sheet at this point? What are the details?
So we've got a couple of different pools of money here. The CHIPS Act, which is this big semiconductor subsidy program, has $39 billion to split up between 600 firms that have expressed interest in the money, and a large chunk of that is going to Intel. There's also a separate loans piece that Intel is interested in, and we've reported that their combined total package from the CHIPS Act will be north of $10 billion. Separately, the Pentagon had initially committed to spend around $2.5 billion to set up sort of a secure facility within an Intel facility to create chips specifically for the military. And Commerce, which runs the CHIPS Act program, was also going to share a portion of that cost. Now, what we reported yesterday is the Pentagon has pulled out from their portion. Lawmakers said to Commerce, you have to cover the entire thing. And forgive the pun, but it's not really clear where the chips will fall on this one. The Commerce Department is actively hashing it out with all of the companies to figure out where they're going to come up with several $1 billion that they didn't realize until a couple weeks ago they were on the hook for.
All right, so Ian, come on in on this. What's your read on what this means for Intel and more broadly about kind of the semiconductor industry here in the United States?
Yeah, I mean, my guys are of the opinion that Mackenzie probably knows more about when this is actually all going to come together and when they're going to get a check in the post than they do right now, and that's, I think, the source of some frustration. For Intel, this is either an excess of what they were going to, in excess of what they were going to get, and a good thing, or it's not. And if it's in excess until we get, then that hurts everybody else because the pool shrinks, and that's bad for some of these other projects, and that's making other companies unhappy or worried. And we get other companies comment in the story, or it's bad for Intel in that a big chunk of what they were going to get and what they wanted to put to general use is going to come with handcuffs. So either way, there's quite a lot to be lost here, and we really need to keep an eye on how this plays out.
Talk to us a little bit more about those handcuffs, what that means specifically.
Yeah, I mean, some of the politicians in Washington are saying, look, this money is all about national security. That should be the focus. Therefore, this CHIPS Act money should be used in this particular way, that these chips that we need made for our military should be made by a U.S. company with this money only in the U.S. in a very restrictive way. And that, it's not bad to have business like that. Intel wouldn't be taking that business on if it was bad business, but it doesn't give them as much flexibility as they want. They want to make chips for everybody, and if a certain amount of their plants and their funding is focused only on this area, then that is not ideal for them.
Hey, Mackenzie, help us understand what sort of the holdup here is. I mean, there's no question that if Democrats and Republicans agree on a few things, one is certainly, and we're going to talk about TikTok in just a moment, but it's certainly the idea that investment in U.S. chip companies needs to increase, especially given the concerns about this technology getting to China. What's the conversation that's happening about the holdup here and why this is taking so long?
So, I mean, one thing to keep in perspective is this is a decades-long investment from Washington. And so when you ask the Commerce Department about what their timing looks like, they say, we're moving quickly, but we're going to take as long as it requires to get it right. A couple of weeks don't make that much of a difference in the grand scheme of, is Intel going to become this American champion chip company? It does make a little bit more of a difference if you're running for re-election. So there are some competing factors here. But at the end of the day, the Commerce Department's been engaged in these really intense negotiations with, there are 4 sort of really advanced chip companies that are vying for $28 billion out of $39 billion that's available for grants. So we're really talking about a couple players. It's Intel, it's TSMC in Taiwan, it's Samsung in South Korea, and it's Micron, which is an American memory chip maker. And they're engaged in intense negotiations with those 4. They don't want to give them a penny more than they need. The companies have asked for twice the funding that's available. So it's not surprising that it would take some time. But this whole Pentagon situation really threw a wrench in an announcement that, could have happened a bit ago.
Mackenzie, just to follow on that, I do wonder how much of this is politics, how much of this is policy. And so just to play a little bit off of that, because we are in a presidential election year, and I'm thinking the layperson is hearing this and being like, well, why do I care about this? How does this impact me specifically, Mackenzie?
I mean, I think that the CHIPS Act combined with the Inflation Reduction Act, which is Biden's signature climate legislation, combined with the bipartisan infrastructure law, these are 3 massive pieces of economic policy that have sort of formed the trifecta of what the White House has dubbed Bidenomics. And so while we're to lawmakers or to allies, the Biden administration is making a strict national security argument saying it's dangerous to have these chips over-concentrated with production in Asia. China is rising in this space. To the American people, they say, look at this $20 billion factory that's the largest investment ever made in Ohio. Look at the thousands of jobs that are going to be coming to upstate New York, to Arizona. So it's really this is American manufacturing. This is the revitalization of American manufacturing, and especially in some key swing states, Arizona in particular, where we have Intel and TSMC building, you should expect this to be a big part of Biden's re-election pitch.
Hey, Ian, last question to you, just 30 seconds here. Help us understand, we talked about different constituencies here. We talked about Washington, we talked about the political base, but for investors, what do they need to understand about this trickle of money that's looking like it's pretty slow here?
Best way to look at it is through the Intel lens. Intel does not have the money to do all that it wants to do. Government subsidies, government grants, government loan guarantees are a big part of its ability to go big or go home here, and they've made that clear to investors. And so if you want to put money to work in Intel, you want as much as they can get, as quickly as they can get, in order to help this turnaround.
Right, as included in that story that the two of you wrote together, Intel CEO has told investors that the government money will help fund the chip makers' ambitious turnaround effort. So important. Ian King, thank you so much. U.S. semiconductor and networking reporter there in our San Francisco bureau. Mackenzie Hawkins, U.S. economic and industrial policy reporter, joining us from our D.C. bureau. So, Tim, from one national security argument involving tech to another we go. We've got to talk about the U.S. vote on TikTok.
Yeah, TikTok facing its most serious challenge yet. This after the U.S. House of Representatives overwhelmingly passed a bill to ban the app. That is, unless its Chinese owner sells the video sharing app. Representative Buddy Carter is a Republican from the state of Georgia who co-sponsored the bill to ban TikTok. On Bloomberg Tech earlier today, right after the vote, he said the law is an important national security measure and not a ban. Check out what he had to say.
Two questions here. First of all, this is a question about, is it going to be banned? No. They have to divest themselves. That's a question that only they can answer. The second question is us in Congress, us in the House and in the Senate, and that is, this is about national security. Now, are we going to take national security seriously?
That's Representative Buddy Carter, Republican from the state of Georgia, who co-sponsored the bill to ban TikTok earlier today.
All right, so Tim, let's get more on this. Let's turn to Bloomberg News national security reporter Dan Flatley. He's with us from Washington, D.C. Hey, Dan, first up, the vote in the House, 352 to 65. Before we move on to the Senate vote, which is a whole other story, what do we need to know about the lead up to today's vote and today's overwhelming, I should say, vote in favor of banning TikTok, or at least telling them they've got to do something?
Yeah, I mean, I think if you had told people a week or so ago that there was going to be a bipartisan vote in the House of Representatives that was going to get 352 votes in favor of something, they probably would have laughed you out of the room. I mean, this is a Congress, especially in the House, that has been sort of mired in a lot of dysfunction. There's been fights over who's going to be speaker, all of this stuff. But, TikTok has been one of those things. Every once in a while, the stars sort of align in Washington. And this is a case where, this sort of happened. TikTok has been a long-standing national security concern for a lot of folks on the Hill. And two individuals in particular, Chairman Mike Gallagher, who's the chairman of this committee that's focused on competition with China, and his Democratic counterpart, Raja Krishnamurthy, sort of worked behind the scenes very quietly over the last several months, building consensus, building support for this carefully crafted, as they say, bill, and working with the administration to kind of line everything up. And it's an election year. There's a lot of different things, a lot of different strains to follow, and they got it done, and they got it done without anybody really finding out about it, including TikTok's lobbyists, apparently. So that's a pretty impressive feat in Washington these days. Yeah. So.
Danny, I just want to know about the security concern here, because this is an app that, as you write in the piece, 170 million Americans use. Critics do call it a national security threat. What can you tell us about whether or not it is a national security threat? What do critics say?
Right. So, there's a couple of things that critics of TikTok sort of focus on. Obviously, there's the data issue, which is probably where a lot of experts sort of say they're on their firmest ground. If you recall, several years ago now, the Chinese Communist Party, the Chinese government passed a law that any tech company, or any company really, could be required to turn over data to the government if asked for it. And so, the TikTok folks have said and been clear about, the fact that they are not sharing data with the Chinese government, but they can't give lawmakers on Capitol Hill or folks here in the Biden administration enough comfort with that sort of guarantee to basically counteract what people are seeing Chinese government do. So that's kind of part one. Part two is this question of propaganda, influence. There's a big thing, I'm sure you both will remember, all the Russia disinformation around the 2016 election that happened. There was iterations of that in 2020. This is a very sensitive area for a lot of different reasons. And in a way, what happened last week, where you had a lot of folks from TikTok sort of prompted by the app to call their representatives, is on the one hand, sort of American democracy in action, right? And that's what TikTok's proponents say it is. On the other hand, it's sort of like, oh, is this an influence campaign? Is this something that could mobilize a lot of people to do something that they might otherwise not do? And I think that's how the lawmakers on Capitol Hill chose to interpret that particular event.
Right.
So there's data, propaganda, influence, all of that sort of stuff.
Hey, just got about a minute left here. Dan, I do wonder, it now moves to the Senate. Our Josh Green out in the BW newsletter writing that the biggest obstacle to a ban on TikTok is that there are so many politicians with competing plans and big egos eager to impose one. And we're talking about senators already picking nits with the House plan. What's the outlook of this getting through the Senate anytime soon? And got about 35 seconds.
Sure. Yeah. I mean, big egos are not in short supply in the United States Senate. That's for sure. Everybody has kind of their idea of how they want to do this. It all comes down to the chairs, the committee chairmen and chairwomen, and what Schumer and McConnell want to do. And, you know, they may arrive at a solution that moves quickly or they may not. Experience would tend to say they will not arrive at something very quickly, but you never know. Sometimes when something is moving, it's moving and you can't stop it. So we'll just have to see. We'll know a little bit more in the coming days.
Or somebody tweets and then the whole conversation changes.
Carol, all I'm going to say is get your TikToks in now, okay?
I'm not a TikToker, folks. I'm not even on Facebook.
Okay?
I'm not on any of that stuff.
Get them in while you can.
Just going to say, Dan, appreciate it. We know it's a busy day for you. Bloomberg News national security reporter Dan Flatley. Hey, coming up, a really cool story.
Yeah, the OpenAI-backed startup that's building a software brain for robots. We check in with Ashley Vance after this.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
DOJ or other authorities
could face bigger challenges next.
It was going to keep winning World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
It's 2:21 on Wall Street. We do check check markets all day long. We have got a record right now for the Dow Jones Industrial Average up 107, a gain there of 0.3%. Stocks are fluctuating near record levels, with the S&P right now a little changed, higher by half a point. NASDAQ is down 47, a drop there of 0.3%. The 10-year 4.18%. We have got the 2-year 4.61%. Gold up 0.8%, 21.75 the ounce. West Texas Intermediate crude up 2.7%, 79.63 a barrel, while Bitcoin is up 2.6%, 72,891 on Bitcoin. Eli Lilly is teaming up with Amazon to expand its nascent business of selling weight loss drugs directly to patients. Shares of Lilly up 0.2%, Amazon up 1.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Appreciate that update, Charlie Pellet. Well, I got to say, it's a story that we knew we so wanted to do as soon as it crossed the Bloomberg late yesterday. First of all, it's because it's from Ashley Vance. And secondly, because it does have an element, a big-time element when it comes to the AI craze, Tim, but with a little bit of a twist.
Yeah, it turns out making robots smart, not so easy. Enter Physical Intelligence. It's a new company. It's giving its first public interview since founding the company. That interview, of course, to Ashley Vance, Bloomberg Businessweek features writer. Ashley, also the author of Elon Musk, Tesla, SpaceX, and the quest for a fantastic future. And When the Heavens Went on Sale, the misfits and geniuses racing to put space within reach.
Listen, we're just going to say it. He's our go-to for a peek into the world's future. Ashley Vance, of course, joining us from California, Palo Alto. Ashley, really good to have you here with us. I love how the story starts. We both do. In that when you think about like the big screen or movies or science fiction, when we think about robots, they're very human-like and they can kind of do anything. Turns out in real life, that's not necessarily the case.
Yeah, every science fiction world I think we've ever encountered usually has very smart computers and very smart androids and other robots walking around. But our world has been different. These large language models that have become so famous from OpenAI and Google and others, they're stuck on our computers, and our robots in factories and even in the home have lagged behind this new, more general purpose form of intelligence.
All right, so then take us to Physical Intelligence, the company that you write about and the CEO that you got to talk to. The first interview since these guys were founded. Tell us who they are and what they're up to, because they're trying to change this.
Yeah, I mean, it's a collection of robotics and AI experts. A bunch of them come from Google. Google's had this robotics team for a long time, and then there's some professors and some entrepreneurs in this group. And the big problem here is that the AI that we're used to, these chatbots, they get fed with all of the billions and trillions of words on the internet and books we've written. And so the quest is, how do you feed robots enough data to train them on these AI models? And this group of researchers, they just think this time has come where we can gather enough data in the right way to make a general purpose robotics brain. So not software for one robot, but a type of operating system that you could apply to any machine, and it would have this base level of intelligence to perform tasks.
How do you teach, Ashley, a robot to tie a shoe, for example, to do a basic task?
Yeah, this part's cool. So, the way this has been done for the last 5 or 10 years is you buy a bunch of robotic arms, or you build them, and you have them tie a shoe about 1 million or 10 million times until that, and you tell it when it's doing a bad job and when it's doing a good job, and eventually this little robot hand can tie a shoe. What these guys are talking about is this new era where you do actually take the language AI models and infuse it into these physical models. And so now, already today, this is happening where you can tell one of these robots, tie a shoe, and because of these language models, it probably, and all of our image and video models, it has a pretty good idea of what the concept of a shoe is, what the shoelaces are. There's probably a lot of videos on the internet of people teaching kids to tie shoes, and so it sort of comes in with this knowledge. Same sort of thing. If you said, pick the Coke can off the table, it will know what a Coke can is and be able to separate that object from other objects. So they're trying to piggyback on this base level of general intelligence and then build the mechanical parts into it.
Ashley, when this processing is happening in real time, is it happening separate from the cloud? That is the actual brain of something with physical intelligence? Like, is the vision for that actual brain to be physically inside the robot versus that processing happening offsite in the cloud, independent from the physical thing?
Yeah, like to a degree, all these models have to get trained in the cloud because they require tens of thousands of these graphics chips to do the training. But we're seeing more and more, even with like a language model, you can ask ChatGPT questions on your cell phone and have them answered. So the part where you've trained the model happens off in the cloud in these huge data centers, but the robots will have this kind of local intelligence, just like we do on our devices. And that stuff, I have another story coming soon on how all this processing on the devices themselves is going to get faster as well.
Love this. Having said that, talking to ChatGPT to create a poem or something, is that easier than actually, getting the next generation AI to teach someone to physically do something? And I guess, what's the data sets on that? Are there less data sets on that to actually teach these physical capabilities?
Absolutely, yeah. I don't want to make it sound like this is a done deal. It's sort of.
I just want someone at home to do my laundry other than me. That's what I'm talking about, Ashley.
We're getting close. We're getting close. I mean, it's funny because robotics, I think we've had these sort of like false hopes so many times where it seems like they're about to do all these incredible things, and they never seem to do it. And the challenges here are real. I mean, this gathering of the data is still a problem. Physical Intelligence's plan is to, most of the companies so far, they've built their own robot, and it's a single thing, and they train that single thing really well. Physical Intelligence wants to buy robots from everybody, smart machines from everybody, train this general purpose data set. So they're just going to buy them, run their AI software through it, and gather this data. But then they also think we are, because of the advances that have happened in AI in the last 4 years, that we're at a new spot where a new era of robotics is possible. But all of this is theoretical. They're not the only company trying to do this. It's a bit of a race now that has just begun this year, and we'll see if somebody can actually solve this problem.
Well, Ashley, what does the end of that race look like? And you've spent a lot of time in Silicon Valley. You've spent the past couple of years immersed in this type of technology. How close are we to that finish line?
It's interesting. There's companies, a prominent company called Figure AI. It's just raised more than $600 million to build an Android. Tesla has this Optimus Android. There's other companies doing that. So, in terms of the actual machines over the past 18 months, I've seen this huge leap forward. I've been to Figure's factory. I mean, the androids are cool, and they can move and all over the place. They've got these cameras. They can see forward, backward, all around. And I've seen them carrying boxes in like a makeshift warehouse. So that part is okay. It's still this software layer. I mean, you can teach a robot to do a repetitive task today. You just cannot send it out into the world, almost like a self-driving car where it has to deal with these variables of the world. We're just not to that point yet.
That's exactly what I thought about when I read your story. Is it akin to Tesla and the other companies that are creating the autonomous vehicle technology, right? So that they can they could essentially then sell it to whatever car or whatever vehicle, but fine-tuning it so it really gets it right every time. That's kind of what this is about, right?
It is. And, like with those cars, I mean, we forget, it's like a decade-long effort. So they've been gathering data for this decade of all the streets and roads and signs and what people and bikes look like. In this case, same thing. I mean, maybe you have enough money to build 20 prototype robots. Is that enough to gather the amount of data that we're talking about here? I think the stakes are very high out on a road with a car. Maybe, if we're just talking about sort of like a factory robot doing a bunch of different jobs, that's probably a less dangerous and sort of easier thing to get to. If you start putting it in the home, obviously you want that to be safe. So there's this, but this is the question. It's this race. these people think they have figured out a new way to gather this data, but we're still just not totally sure.
Like C3PO,
Yeah.
and
Yeah.
R2D2.
Sorry, it's been a while since I watched it, but that's what we think about. Like these guys could do a lot of stuff.
They can. Okay, so Ashley, you spent time at Figure AI. As I said, you've been doing this for years. What scares you about this tech, if anything?
Well, I think we're like a long way off from this getting to some robot that's barging around your house, taking it over. I think, it's similar to so many of these questions. Already, Figure doesn't like to talk about this. They talk about the robots being complements, but clearly they're trying to do jobs that humans do today in warehouses. They're probably not the most pleasant jobs, but they are. There's a lot of jobs, and they pay, and so there's a challenge coming with that. I think in general, and then also you're talking about all these huge fears we have about AI. I mean, you're giving it a body, and it seems a little less scary sometimes when it's stuck on a computer instead of acting out in the world. And so this would be a new era in our AI conundrum.
Yeah, just another one. Really great stuff, and so much stuff, and some history in terms of other companies that have tried to do it before, and all of those that are out there also pursuing something similar to this company. Ashley, thank you so much. Like we said, we saw this company last night, went across the Bloomberg, and knew we wanted to chat with you about it, so thank you. Really appreciate it. That is, of course, Bloomberg Businessweek feature writer, Ashley Vance.
The real Ashley Vance, not an AI version of Ashley Vance.
No AI there.
No,
it's just intelligence.
The real human Ashley Vance.
We think. Do we know?
That would be a feature.
That would be a feature. Speaking of features, his story is featured in the forthcoming issue of Bloomberg Businessweek. You can read it now, though, on the Bloomberg terminal, of course, at Bloomberg.com.
All right, well, the S&P 500 is in the green, so that means it's at a record. The Dow Jones Industrial Average higher by 0.3%. And pulling up the NASDAQ 100 right now, it is down by 0.5%.
All right, straight ahead, we're going to talk about the world of private credit, but right now, we're going to talk about world of national news, courtesy of Amy Morris. She's in D.C. Hey, Amy.
Hey, Carol. Congress voted to pass that bill that could lead to a ban on TikTok in the U.S. The legislation would prohibit the app unless its Chinese parent company ByteDance divests within 6 months. Democratic Representative Robert Garcia of California argued against the bill.
I'm a strong supporter of ensuring that TikTok remains an open marketplace, and there's no guarantee in this bill that there won't be an interruption of service that could lead to an end of this app.
China condemned lawmakers' push to force the sale of TikTok and says it would use every legal tool to fight back. The judge overseeing the Georgia election interference case has dismissed some of the charges against former President Trump, but others remain. The judge ordered 6 of those charges be quashed, including 3 against Trump. The order leaves intact many other charges in the indictment. U.S. accident investigators say they still don't know who performed the work on the panel of that Boeing jet that failed in January. National Transportation Safety Board Chair Jennifer Homendy told senators in a letter that they asked for those names and other information days after the accident, and they still don't have the information. They say it is, quote, absurd that Boeing still has not provided the documents nor the information. Boeing had no immediate comment on the situation. Global news 24 hours a day, and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet.
I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Let me ask you about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got U.S. stocks fluctuating right now. The S&P 500 index lower by half a point, little change, perhaps the key takeaway as of now. Again, we have been swinging between gains and losses. We have got the Dow Industrials up 110 now, up by about 0.3%. The NASDAQ Composite Index down 41, drop now of 0.3%, has been lower for much of the session. 10-year 4.18% with a 2-year right now 4.61%. Spot gold is trading higher. Gold up by 0.8%, 21.76 the ounce. West Texas Intermediate crude is advancing 3%, 79.85 a barrel, while Bitcoin also up 3% right now, 73,228 on Bitcoin. Cruise stocks all sailing higher right now. Goldman Sachs says the impressive run from cruise line operators over the past year has more room to go. Goldman says there is a favorable setup where demand should outpace supply and result in improved prices. Shares of all three right now, we have got Royal Caribbean higher by 2.2%, Carnival Corp up 3.1%, and Norwegian up now by 2.2%. Again, recapping, stocks are mixed. S&P higher now by just about half a point. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Really do appreciate it. It is Bloomberg Business Week. Tim Stenevec and Carol Master. Need a loan for a new factory or a buyout deal, but don't have the terms or like the terms that your bank is offering? Well, there's a $1.7 trillion industry that's ready to help. We're talking, of course, about private debt, part of private credit.
All right, big picture, everybody. We've got a chart we want to pull up for everybody. It shows the growth since 2018, specifically the value of current portfolios when it comes to private credit. What it doesn't show, though, is that there's also a lot of unused capital just waiting to be put to work. In 2023, that meant another $500 million or $500 million just waiting for a deal. So that means over $1 trillion, like we said, easily in 2023. But generally, for those on radio who are listening as well, you can just see that in the last 5-6 years, we continue to incrementally see the growth when it comes to private credit.
Okay, so a little bit of a history lesson here. Private credit came of age after the 2008 financial crisis, and today it's become a serious rival to mainstream lending for all kinds of businesses. Some have argued that private credit should become a permanent fixture in capital markets and investment portfolios, yet it's not quite clear how what some people consider an opaque corner of finance will cope when the next big recession hits.
Two sides to every coin. All right, that brings us to our guest, Kyle Brown. He's president, CEO, and chairman of the publicly held Trinity Capital. He's here in our Bloomberg Interactive Brokers studio. Trinity Capital, by the way, a business development company making both debt and equity plays. Kyle, great to have you here with us.
Thanks
How are
for having
you?
me, guys. I appreciate it.
Well, great to have you here. Private credit, we talk about it so much. It feels like every investment advisor has some thoughts or wanting to be involved in the private credit space. Tell us about the trends that we are seeing and how it compares to the last 6 months to the last 12 months.
Sure. And maybe just a little background. So we've been doing this since 2008, focused on growth stage companies, mostly private companies. Providing senior secured financing in the form of term debt and equipment financing. So anywhere from kind of growth stage heading towards an IPO or liquidity event to M&A PE-backed company after the fact. So private credits continue to grow. It's continued to be, I'd say, maybe even more prevalent over the last 12 months since some of the banking volatility took place. I think what we're seeing is banks lending less and companies looking for alternative sources of capital. And so pipeline-wise, it's been significant growth over the last 12 months specifically, although it's been steadily growing, over the last 5 years.
What can you tell us about, speaking generally here, because every deal is different, but what are typical terms on a deal and how might they be different from the type of deal that someone were able to get from financing from a quote-unquote traditional means?
Sure. So, in most cases, you're going to see a little bit less leverage, particularly with kind of this growth stage sector. We average anywhere from 20 to 30% loan to value. Value meaning the last priced round or last 409 valuation, lower of the two. So they're lightly leveraged companies, right? They are, they're growing.
Is that something you guys specifically, you want light leverage?
Lighter leverage, right?
Yeah.
I think what you see there is less impact from rate increases as a result of that. Companies, a 300 to 500 basis point increase is not significantly impacting their bottom line. It's challenging it, but it's not significantly impacting them.
If I can build on what Tim just asked you, in terms of terms, though, specifically for the deals you are doing, whether it's over the past 6 months or so or last 12 months, have you been asking for companies to pay more to get a deal done because you're concerned about their exposure to whatever, or you're worried about the business environment or whatever?
I think our gross yields have been rising, and they have been. You can see it on our investor presentation online, but the gross yields have been rising. Warrants and some extra equity kickers have been rising as well. And that's really more of a product of just supply and demand. There's less capital available. They're getting less capital from banks. And
so you can do it, in other words.
So we can do it, right. And there's an exchange there. So we have finite amount of capital as well, right, alternative lenders. And so we're getting a little bit better pricing over the last 12 to 24 months.
Because you can.
Because we can.
What would you say to critics who say that this is indeed an opaque corner of finance?
I think it's been around for a long time. right? I think
Has it been tested, though? You came in 2008,
Yeah.
or your firm has. Do you really feel like it's been tested?
So I think that venture capital has steadily been building equity investments as well as private equity investments. And so that market hasn't changed. Even after 2000, you saw a pretty big rebound in the amount of capital that's deployed in 2021. So I think investments, particularly in technology where we focus, it's a good play. And it's been tested multiple times especially over the last 4 to 5 years, right? With COVID, with inflation increasing, equity investors continue to support companies. The biggest challenge I think you're seeing out there, it's not are these companies going to survive or can they make it? It's at what valuation will they continue to raise capital? And you're seeing pretty significant valuation fluctuations right now.
I am also curious about the exit strategy. How quickly do you guys normally exit an investment?
So a third of our deals we are repaid through an IPO or M&A. A third is through just regular payoffs. So our deals end up amortizing. You talk about terms. They're interest only for 12 to 36 months payments, and then they're fully amortizing over 24 to 36 months. And so
3 years and you're out?
We're typically out in less than 3 years.
And that's been consistent even over let's coming off the pandemic. Has that stayed consistent?
It's been very, very consistent.
Huh.
The other corner is just refinances. We'll get refinanced out if it's a strong company that continues to grow.
What do approvals denials look like in terms of companies coming to you? Like, what is the success rate for incoming versus, you guys saying, okay, hey, this is not quite a fit for us providing financing?
Yeah, I think historically we've averaged maybe 3% of the deals we look at, right? That's companies where we've seen multiple years of financial statements, pitch deck, cap table. So we're getting a good look, and we're only funding about 3% of those. Wow. That has actually narrowed over the last 12 to 18 months. Top of funnels increased because deal flows increased since the banking volatility. And then we're just getting a little bit pickier on what makes it to the bottom.
Why are you getting pickier?
We want to make sure that companies have the adequate runway to get through the next couple of years of volatility.
Well, you talked about refinancing or refinances in terms of some of your firms. How much do you typically do that for a company that's been in your portfolio? How much more have you done it coming off of maybe the last couple of years when there's been some concerns about some strain and stresses, especially as the environment has gotten a little bit questionable?
So I think we're probably a little bit unique. Our internally managed BDC, and there's only a couple internally managed BDCs, our company in Trinity is not just a pool of assets. It's actually owns the management company. So when you buy the stock, you get the management company. We also have third-party valuations on all of our assets, and there's transparency there for investors, so they can see from us and a third party where these assets are valued at. So there's really no hiding the 8 ball from evaluations or from the portfolio standpoint.
So you're not having to do some kind of an increasing number of refinancing, maybe with tougher terms for the borrower in the last 6 to 12 months?
The majority of our investments right now are new investments.
Okay.
80+% of our capital is being deployed into new opportunities.
You mentioned IPO market, though. Is some of that more difficult in the last 12 months? It's been not a great IPO market.
Yeah. No,
so do you have to shift gears and rather, you said about a third are IPOs or M&A, or you do more M&A and less IPO because that's the market?
There's been more M&A, and honestly, there's going to be a lot more M&A coming up, I think. There's this fine dance happening right now between companies who need capital and private equity. You mentioned at the beginning of the segment, ton of dry powder right now. And there's a dance because this equity is going to be really judged on the investments they make in this time period right now. And then you have companies that were raising at a significant increase in valuation over 2020 to 2022, and they're dancing. They're trying to figure out where to land. And you're seeing significant down rounds, whether it's priced or hidden in the form of a convertible note with preference, et cetera. But it's happening right now, and it'll play out over this year.
We talk about that a lot for those who've got dry powder, and depending on how their exits have been, whether or not it's going to go well in the future. Great stopping by. Next time you're in town, come by.
Thank you very much.
Kyle Brown, Chief Executive Officer at Trinity Capital, joining us here in studio.
NASDAQ 100 down by 0.5 percentage point. The S&P 500 in the red as well. This is Bloomberg.
Ursula Hurley walked me through Terminal 5 at New York's John F. Kennedy Airport, where the complexity of the business she oversees really comes into focus.
We operate 1,000 flights a day. We serve over 100 destinations, and we transport about 40 million customers per year. When you think about a person booking a flight to getting them to their destination and home from their destination, it takes an army of things to go right.
There's change on the way at JFK. Ground has been broken on a new Terminal 6. It will connect with Terminal 5 and add capacity for up to 10 gates. JetBlue joins a consortium of companies managing the $4.2 billion project, helping define its design and guide its construction towards completion in 2028.
We're still in the design phase for Terminal 6, but we leverage what other airports have done and what we've seen throughout the world, quite frankly, and we're going to pick the best of everything to really elevate the game. And technology is going to be at the backbone of that journey. We want to be able to create and give customers experiences where they can self-serve as much as possible across the travel ribbon. So whether it's checking in, whether it's checking your bag, going through security, boarding a flight, we want everyone to be able to do that seamlessly and be able to do that with your own handheld technologies.
Company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pettit. Home builder Lennar will be among the names reporting today after the close of trading. The report comes as mortgage rates drop back below 7% for the first time in a month, spurring an increase in applications for home purchases. Among those home building names, we've got Lennar up now by 0.3%, rival KB Home up 1.6%, Toll Brothers up by 1.3%. As we have been reporting, Dollar Tree plans to close about 1,000 stores in a bid to improve profitability as the discount retailer battles a spate of litigation and other headwinds. The company expects to shutter about 600 Family Dollar stores in the first half of fiscal 2024 and shut down an additional 370 Family Dollar and 30 Dollar Tree locations as their leases expire. Dollar Tree up by about 0.1%. Dollar General up by 0.2%. Sources tell Bloomberg UBS Group has started cutting jobs at its Asia private banking division this week as a slump in profits weighs on the region's largest wealth manager. Wealth generation in China has stalled as the nation's economy struggles to gain momentum amid a property crisis and a sell-off in equities. Right now, we've got UBS shares trading little changed. Wall Street's stance on Tesla worsened further today as yet another analyst warned about risks to sales and said its strategy of cutting prices to boost demand was losing its effectiveness. Wells Fargo analyst Colin Langan calls Tesla, quote, a growth company with no growth. And Tesla shares, they are down now by 3.9%. And those are our top company stories at this hour. I'm Charlie Pettit, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. Let's get a check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 Newsroom in Washington, D.C. Hey, Amy.
Hey, Tim, House lawmakers passed that bill that could lead to a ban on TikTok in the U.S. The legislation would prohibit the app unless its Chinese parent company ByteDance divests within 6 months. Supporters like Republican Dan Crenshaw of Texas say China can demand access to Americans' data anytime it wants.
The First Amendment does not give the Chinese Communist Party the right to American data or the right to manipulate the minds of Americans. That would be a really weird interpretation of the First Amendment.
Opponents say the bill targets a single popular platform months before an election, and while President Biden has said he'd sign it, it still has to make its way through the Senate, where it faces an uncertain future. The judge overseeing the Georgia election interference case has dismissed some of the charges against former President Trump, but other charges remain. The judge ordered 6 of those charges be quashed, including 3 against Donald Trump. The order leaves intact many other charges in the indictment. It was no surprise President Biden and former President Trump each clinched their respective parties' nominations yesterday, setting up a rematch of the 2020 election. And this will be the first presidential rematch since 1956, the earliest start to a general election campaign since Bush v. Gore in 2000. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Back to Bloomberg Business Week now with Tim and Carol.
Thank you so much, Amy Morris. So I feel like this could be a Seinfeld episode, because can you be called a dollar store if things don't cost only $1?
I mean, we know that dollar stores, because of inflation and because of, just the way that items have shifted, $2, $3, $4. Well, it turns out Dollar Tree, it plans to extend its range to include products that cost as much as $7 each.
Sorry, I just dropped my pen. All right, well, in our one more
That's
thing.
how surprised you are. That's 7 times $1.
All right, in our one more thing, Dollar Tree implementing a multi-price strategy in which it will sell a greater variety of products with the aim of winning over new customers. So over the past year, we know that they have sold groceries that cost from $3 to $5. Those goods will be complemented this year by 300 items that cost up to $7 across 3,000 stores.
Okay, so the company CEO saying that the expanded assortment will offer Dollar Tree shoppers a wider range of choices across a variety of categories. We're talking food, pet care, personal care. Also, the company is getting higher income consumers.
So it's going upscale?
It's I don't know. Yeah, I guess you could argue that it's going upscale, or it's just attracting people who make more money now because they're offering these different products. So in 2023, its new customers, according to executives on the earnings call today, were mostly households, new customers, mostly households earning more than $125,000 a year.
So basically, bottom line, what they're looking to do is put more offerings out there that cater to a wider variety of shoppers, including those earning more money who maybe want to buy other things, right? Whether it's, I don't know what, pet care, personal care, like all of these things. We know personal care items tend to cost a lot more money. You can't just get them for a couple of dollars. So it's kind of interesting. Yeah.
Not the only news out of Dollar Tree today. The stock is actually down more than 14%. It does plan to shutter about 1,000 stores, this in an effort to improve profitability. The retailer does face some headwinds, including a spate of litigation.
Yeah. So, all right, certainly on our radar, and I bet one of your decliners. All right, guys.
How'd you know? It is one of my decliners.
Just a fair guess. All right, for those of you watching on television, coming up next is The Close. For those of you staying with us on Bloomberg Business Week, Tim and I got a couple of things coming up in the next couple of hours, including we're going to get into the physics whiz who made a fortune betting on nature's catastrophes. We're talking about cat bonds.
Cat bonds. Not meow cat bonds.
No, not meow.
Not meow. Tyson is hiring New York immigrants for jobs that no one else wants. We're going to check in with Tyson and the person who, the Bloomberg reporter who wrote that story,
and then we've got the former owner and chairman of the LA Dodgers. He is out to upend the internet as we know it. Frank McCourt will be joining us. That's coming up on Bloomberg Business Week. This is Bloomberg.
This is Bloomberg.
Large cap stocks adrift again as risk swells for an unwind in upside momentum. That's a bit of a tongue teaser.
That was hard. You wrote it.
Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostic.
And I'm Alex Steele. But you know what? Small caps. Small caps doing really well. We're going to focus on that throughout the next couple hours. We're kicking you off here to the closing bell right here in the U.S. S&P goes nowhere fast, but it's energy, industrials, materials. They're doing really well within the S&P. Henceforth, example, Freeport-McMoRan Copper and Gold. That's really a copper and a gold story. It's the best performing stock within the S&P. 30-year yield auction, it was $22 billion. It actually did pretty much okay compared to, say, the 3-year and the 10-year that we saw earlier in the week. So yields up by about 3 basis points, but nothing to write home about. But we are, for the 10-year, at least over that 200-day moving average. So watch some technical levels. And speaking of the majority of the commodity complex, like a stealth rally over the last 2 months. You got crude up almost 3%, almost right now hitting $80 a barrel, Romaine.
Yeah, that's a big story here on the day in the commodity space. We're going to get to that in just a second here on the show. It's kind of funny because everyone today was really so focused on that softness that we are seeing in those large cap and those big cap tech stocks, but ignoring the relatively strong bid that's going into mid and small size stocks. The biggest volume mover today across all of the tapes, a $2 billion market cap company, SoundHound AI. And the biggest percent gainer out there, the $18 billion retailer, Williams-Sonoma. In fact, the Bloomberg terminal is showing that of the roughly 284 stocks that hit 52-week highs today, 40% of those names had market caps of less than $5 billion, and 72% of them had valuations under 25. In fact, Bloomberg actually has a value ranking score. It takes into account a lot of things like cash flow, market cap, enterprise metrics. The lower the number, the better the potential value. Remember that. NVIDIA's score, as of last week, was 951, among the highest for large cap stocks. To put that into perspective, homebuilder Lennar, which reports earnings tonight, had a score of 104, and General Motors, 9.
Wow.
I had a chance to catch up with Ariel Investments founder John Rogers on Monday. He actually said that historically, when you have that type of gulf in a discount and disparity, well, inexpensive stocks end up posting stronger performance over the subsequent 2 years. But in that conversation, there was still the lingering question of timing. The timing of when small cap earnings will indeed support small cap stock outperformance. The good news, though, is maybe you at least don't need to worry about the Fed. At least that's the take from Bloomberg equity strategist Chris Kane, who in a note just today pointed out that while interest rates and value stocks did move together in lockstep in 2021, that relationship has completely broken down, meaning value stocks in general, Alex, can dance to their own drummer, at least for now.
And maybe that drum is good. Like maybe that drum is producing profits. I'm trying to think of a musical analogy, but I don't have it. And this is where I get that information. So this is the Russell 2000. This is how much average sales growth we saw in the last quarter for all the sectors within the Russell 2000. And you can see weak growth all across 2023. And then boom, we see some nice growth here. Here we're seeing the growth in the second quarter of 2024, and then more growth as we go on throughout the whole year. And that just shows that maybe the move we've seen in the Russell is being supported by real earnings growth. Not necessarily beats, right? Because you can kind of finagle that, but actual profit growth. The only sector that hasn't contributed to that growth is communications. Every other sector, not just tech, but energies, industrials, etc., have all been doing quite well in the Russell's earnings season, Romaine.
Yeah, I mean, look, and this is kind of what creates that disparity, but it also creates a disparity in opinions, and more importantly, a disparity in manager performance. So the question is, where do you go as an investor? Jason Trenner joining us right now to help us kick off to the close here on this Wednesday afternoon. He's the chairman and CEO over at Strategas Research Partners. And Jason, I do want to start off with this, I guess, somewhat mild rotation that we've been seeing into cyclical names, into small cap names, into value names. It appears to be, I guess, a somewhat cautious rotation, but definitely there seems to be some momentum behind it. People want to find something beyond just the Magnificent Seven.
You know, I think that's right, and I think people are generally coming to the conclusion that the chances of a recession are declining, and certainly that was still, I think there are still questions about it, but the most likely scenario for most people is that there's going to be a soft landing. If anything, the U.S. economy certainly seems among to be the strongest in the world, and so I think people have a little bit more confidence in some ways just moving away from things that they know will provide them growth. Regardless, which is tech, and now they're focusing on things that are a little bit more cyclical and a little more dependent upon a continuation of the business cycle.
Absolutely, and in fact, a lot of those names that, of course, got sold off pretty hard in 2022 and even in part of 2023, when everybody thought we were headed off some sort of economic cliff. That's not materialized, and most estimates, at least by the smart folks on the street, don't seem that's going to show up this year at all. When we start to talk about what the Fed is going to do, and more importantly, how the Fed's decision will affect risk assets, how strong is that correlation right now?
Well, I mean, listen, I think at the start of the year, the general expectation was the Fed would tighten 6 times. Now it's probably around 3. If you look at the dot plots, my own opinion, for whatever it's worth, is that like Mr. Waller, I'm kind of in the what's the rush category because the stock market's hitting all-time highs. Bond yields seem to be behaved. You have gold, Bitcoin, copper hitting, breaking out. It doesn't seem like there's a big rush to me to ease, and yet there is an expectation in the marketplace that they do so. So my expectation is that they will ease. It just may not be as much as people had expected even a couple of weeks ago.
What about not at all, Jason? Torsten Slok over at Apollo thinks that yes. Jeffries also pointed out that, look, if we continue to see this positive data, the economy is still capacity constrained. So any kind of tick up in demand will then raises the risk of a renewed bout of inflation.
Yeah, I'm kind of more in that camp, and I don't think we can forget the fact that there is no coordination between fiscal and monetary policy. We're talking about deficits that are about 7% of GDP, which we've only done in periods when the unemployment rate was above 7%. We've never done that when the unemployment rate was below 4%. So my own opinion is the Fed may be a little overconfident here, or maybe the Fed was getting overconfident. I understand there's a lot of pressure on them, and there's a very strong tendency to want to fine-tune monetary policy. But I have to say, with all due respect to the people on the FOMC, I think that's beyond human abilities to fine-tune an economy this complex. I would try to keep it more simple, but I doubt that's what they're going to do. I think they're going to try to thread the needle here, which makes me wonder whether there might be another round of inflation, another wave of inflation as we get into 2025.
Okay, so you think we're of the mind that maybe we'll see cuts, trigger inflation, and then we'll have to hike again next year?
Well, listen, I think I certainly wouldn't declare any big victory laps over inflation if I were the Fed. It has come down from 9 to 3, and that's something that is good, certainly. But as you pointed out, there are a lot of other indications that you're certainly a long way from 2, I believe, which is the standard, allegedly. No one really thinks they're going to have some sort of suicide pact with 2. But certainly, I would think you'd need to get a little bit closer before you really start spiking the football. So I'm a little nervous about what you just described. I don't know if they'll tighten next year, but I do think another wave of inflation is, if history is any guide, is quite likely.
All right, Jason, always great to talk to you. Jason Trennert there helping us kick off to the close. Chairman and CEO over at Strategas Research Partners. A lot more coming up here on the big program, including a big day for TikTok, but maybe not what they expected. The U.S. House of Representatives passing a bill to ban TikTok, and just now, the spokesman over at the White House saying that if it passes the Senate, the president will sign it. A deeper dive into the app and the millions of users affected by this new law.
All right, plus you got U.S. Steel tumbling after reports that President Biden will oppose a planned takeover of the firm by Nippon Steel. Not entirely surprised by that, but that stock really moving. We'll have the latest.
And a focus on commodities today with Natasha Kaneva, head of global commodity strategy over at J.P. Morgan. We'll talk about copper, we'll talk about steel, and of course, some of the interesting moves we've been seeing in the oil market. All that and more coming up in just a bit. This is The Close on Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do.
that brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
The larger industries are doing great, up double digits for 4 straight quarters. But if you go down to the grassroots level, for mechanics and other people who are in factories, they are troubled. You have people in the grassroots who are cash rich.
Yeah.
Their salaries are going up, but their confidence poor. And so what happens in those situations is they pivot towards shorter payback items.
That was Nick Pinchuk, CEO of Snap-on Incorporated, speaking with us yesterday about his views on the economy. Nervous, cash rich, but not going to do much with it because you're scared. So want to get another perspective from the C-suite. Joining us now is Scott Salmirs, President and CEO of ABM Industries, one of the world's largest providers of facility services and solutions. So we're talking like air conditioning, janitorial services, lighting, parking, security, all the guts of the stuff you need to run a building.
That's right.
Thanks for being here.
Yeah.
Okay, so give us the 10,000-foot view. Like, how's it going? How's demand? What's your visibility for this year?
Yeah, so we're optimistic, right? And to give you context about ABM, we're, again, 100 years old, Fortune 500 company, and 120,000 employees. And it's amazing that we started with one person with a bucket and a squeegee cleaning retail windows, and now here we are. And we have a really good purview because of the industries we serve, because we're in commercial real estate, we're in aviation, education, and manufacturing and distribution, which is so hot right now. So we're optimistic, and there's definitely an overhang on commercial real estate, but we have good insight because we have relationships with tens of thousands of tenants across the country, and the hybrid is here to stay. But there's definitely a move back to the office, and it's palpable. I think a couple of years ago it was 1 to 2 days a week, then it's 2 to 3.
Yeah.
Now we really feel like it's 3 to 4.
But does that not affect your business? I mean, if a building's full 5 days a week, like pre-pandemic, and it now goes down to being completely full, say 3 days a week, does that change what you are there to do?
Well, it puts a little compression on us because when tenants compress their space, right, we feel it. But because of our labor model, if a tenant takes less space, we can furlough the staff or put them in another location. So our margins stay relatively strong. And even with all the compression that's going on, which isn't as dramatic as people thought, because 2 years ago, we thought every tenant was going to take half as much space, and it's really not playing out that way. It's turning out to be 10 to 20% less. So for us, we're really resilient, and this past quarter, our revenues in commercial real estate were flat year over year.
Yeah.
So we're not feeling it as much as you would think.
Where's the good part? So commercial real estate challenge, but like you're hanging in. Where are things really strong?
Class A. So all real estate is not created equal, right? Class A space is actually pretty much thriving right now. It's the B and C space, the older space, the ones that need retrofits. And let's go back to my compression point. So if a tenant is taking 20% less space, right, but they could still spend the same amount of money on rent, they can upgrade to a better building, to a Class A building, which, as you guys know, is so important for retaining employees, for attracting employees. So there's this major shift towards Class A, and it's proven out to be very resilient.
And so that's sort of the lay of the land of what we're seeing in office real estate. Obviously, you do a lot more than that.
That's right.
Airports, entertainment venues, things like that. What, though, is the future when we start to talk about the next generation of commercial real estate. I assume that's not going to be gleaming new office buildings. It's going to be something a little bit different. What?
Yeah, well, I am optimistic about commercial office buildings. I think it's just going to take a little time. Right now, it's manufacturing and distribution facilities, right? With the semiconductor business coming across, with the CHIPS Act, which I know you guys know about. I mean, right now, we're servicing 10 of the biggest semiconductor companies in the world. We had our executives over in Korea last month talking to other semiconductor companies about onshoring to the U.S. And again, this is so interesting. I don't think people realize when they think about a semiconductor facility, it would probably surprise you to know they're the size of 2, 3, 4, 5 football fields. I mean, these are massive facilities. Yeah, it's incredible. And the pandemic really showed us the fragility in the supply chain with semiconductors. So I think that's really exciting and part of our future.
And we're already seeing some of that build out, or at least the sort of the early stages of that.
That's right.
Another big infrastructure project that was also tied to the CHIPS Act and has been ballyhooed out of Washington is building out more of a electric vehicle charging network. Anyone who owns an EV that's not a Tesla knows the troubles that you're going to have out there if you try to drive more than like 10 miles.
Right. Yeah, it's, they have a name for it, range fear.
Yeah.
Right, so people have it and they're, where am I going to get to a charger? And there's just not enough infrastructure, right? So hopefully the Infrastructure Investment Act, they have $7.5 billion allocated to EV infrastructure. That's going to be a big catalyst because there is demand for EVs. People want them, but they need more infrastructure. So it's coming. It's coming. And our backlog at ABM is starting to soar.
So what am I looking at here on the screen? Are you making the actual chargers?
We are. We are. We're designing them, we're making them, and we have the brains inside of them as well. So it's a complete turnkey solution. And it's not only just the residential consumers, it's also the big fleets because everyone's put their carbon protocols out, right, for carbon reduction. One of the easiest ways to do that is by changing your fleet out.
And just real quickly, so are your customers on the EV side, EV charging side, are they mostly private residences and private?
We don't do residential. It's all commercial.
It's all commercial.
Dealerships and then fleet.
And fleet.
Yeah.
Okay. Interesting stuff, Scott. We have to get you back to talk a little bit more about that. A big topic for us here on the show. That's the CEO over at ABM Industries, a much broader company with a great read here on what's going on the ground when it comes to commercial real estate. Coming up here on the big show, we're going to get you a read on the housing market. We do get some earnings after the bell, including out of Lennar. We're going to talk to an analyst and get his view on what to expect. Our top calls up next on The Close, right here on Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, let's get a view from the sell side with our top calls. Big movers on the back of analyst recommendations. And we're going to start off with Tesla, the ultimate growth stock, not showing much growth as of late. That's at least the opinion of analysts over at Wells Fargo, cutting their recommendation to underweight. Tesla now has 13 sell equivalent ratings. That's more than double the number from just 11 months ago. The analyst over there, Colin Langan, says Tesla's strategy of cutting prices to boost demand, that's played out. And he expects volumes to remain flat this year and fall next year. Shares down about 4% here on the day, a 30+% drop to start the year. Next in line, Texas Roadhouse, an upgrade today to outperform over at Baird for what the analyst calls standout traffic at its restaurants. He says the shares still have plenty of room to run, even with the recent strength factored in. The analyst raising the price target to $175. That implies a 12% rise from current levels. That would be significant considering that 155.30 is set to close at a record high today. And finally, let's take a look at Tri-Point Homes, an upgrade to outperform from Sector Perform over at RBC. The price target set at 38. The analyst citing improved pricing for the home builder, and he expects that strength to translate into gross margin and profit upside as the year progressive. Tri-Point, of course, focuses almost exclusively on those high growth areas in California and the U.S. Southwest, and investors right now focus in on this stock. A nice bump here, up about 3%, the best day for that stock since late January. Those are some of our top calls, but we want to stay in the housing space because we are expected to get results out of a much more national home builder. That is Lennar. Those results set to drop in just about an hour. New home orders and closings expected to rise, giving the home builders focus on volume growth. As far as gross margin, though, some analysts are expecting last quarter to maybe be a low point. Tyler Batory joining us right now. He's executive director and an analyst over at Oppenheimer. He's got a market perform rating on the shares. And Tyler, Lennar and really the rest of the home builder space, really one of the standout, if not kind of surprising moves higher that we saw in 2023. When we look at that momentum in the shares, how does that carry over into 2024 based on the earnings that we've seen so far?
Yeah, well, certainly we'll find out an hour from now when Lennar does report earnings. I think a little bit of a tricky setup for the stock here heading into the print. There's some good news and some bad news. On the good side of things, we do think that demand for new homes has remained strong into March. Lennar is a very volume-focused builder, so they should be well-positioned to take advantage of that. Wouldn't be surprised if the number of homes that they close, if their orders in Q1 are better than expected. Also would anticipate their commentary the rest of the year to actually be pretty positive as well. The bad news and the risk we think is really around gross margin, because at the end of the day, it's one thing to sell more homes than Wall Street expects. It's another thing to sell them at a lower margin than Wall Street expects. And that's really where I think there could be some risk here.
Well, that's what I'm curious about, and particularly what you would ask on the conference call, because management has made it clear that that volume strategy is their strategy. Now, I'm not sure if they're saying that's going to be intentionally at the expense of profitability, but when you're trying to grow that fast, particularly at a time when the metrics, the unit metrics, maybe starting to work against you, do you still stick by that strategy?
Well, we'll see what happens. If you take a step back and you just look at what Lennar is trying to do, they're really trying to have a consistent sales cadence in terms of the number of homes that they're selling, and they're willing to fluctuate with their gross margin, really fluctuate with price and incentives to hit that consistent target. And if you take a step back and you look at this, if you can sell more homes, in theory, you should be able to take market share. You can leverage some of those sales on top of your fixed costs. You can also get more efficient in terms of your land strategy. And over the long term, I don't necessarily debate the merits of the strategy. The problem is quarter to quarter, Wall Street's still very focused on gross margin. They're very focused on earnings. So if you have a business model where there's potentially some inherent volatility in those metrics, that's where the risk comes in. That's why we think it's a little bit tougher to own this stock here.
Well, I mean, it's at a 52-week high. Looks like it actually is a record high. It has a tremendous run. Is there any catalyst, though, we might see that could justify this move? I appreciate you're skeptical, but is there something, like if the margin story isn't terrible or if the concessions that they've been offering kind of get thrown on the back burner?
Yeah, so I think a lot of this is really going to depend on what they guide for Q2. If you think of what they're going to report, they're going to be reporting earnings through February. In December, January, February, not exactly peak times in terms of home sales. It's really the spring selling season, which is happening right now and going to continue for the next couple of months. So we'll see what they have to say. And it's really, again, back to the margin side of things. If they can sell more homes than the street expects and they don't have to cut price and they don't have to offer incentives, that's really where you could get some upside in terms of earnings. From our perspective, yes, Lennar has been an exceptional performer. I would note Pulte Homes and Toll Brothers, which we also like a little bit better than Lennar, slightly different strategy, have actually outperformed over the past year. That's really where we think investors should be. From a broader perspective, though, we're very bullish on home builders. We have been bullish on home builders for the better part of a year and a half. I do think the sector has a lot of tailwinds behind it. So I would expect these stocks generally to move higher. Just think there's some different opportunities that are out there in different companies.
All right, Tyler, thanks a lot. Super appreciate it. Tyler Batory over at Oppenheimer. And what's interesting is that this is the first home builder to report that is going to then also take into account mortgage rates going with a 6 handle to a 7 handle, which is what we saw in February, and like what they noticed in terms of the correlation between sales.
Yeah, I'm curious about this strategy, and then you have to put that against the backdrop of valuation of stock that's up 10% to start the year, and that's coming off what, a 60+% gain that we had last year. I do want to just turn our attention real quickly away from home builders to WW. This is Weight Watchers, the former Weight Watchers. The shares actually dropped about 12% in less than 15 minutes. No real news right now on the wire, but something to keep an eye on. They were down as much as 16%, now down about 11. There are some third-party reports out there that Bloomberg will try to get a handle on here, but one of the stocks to keep an eye on. We'll be back in a moment. This is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
I want my little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. And I know we can make, big hay about some tech names being down or like Tesla getting hurt again. But, it's the real economy stuff that's outperforming today. I mean, energy is up, best performing sector in the S&P. Freeport is the best performing stock within the S&P. That's a real demand underlying fundamental story.
Yeah, does this mean like what, the economy is back?
Maybe?
I don't know.
I say maybe because I don't know if there's a line between the commodities and global growth in the way that there has been, say, 30 years ago. But this is the real economy that's doing well.
But it gives you kind of real-time sentiment. We always talk about stocks being that forward pricing mechanism, but when you look at spot prices, even future prices in the commodity space, that seems to be much more reflective of the here and now.
Yeah, so let's get to it.
Yeah.
Copper rallying, as we were just saying, to the highest level since last April. So this is the why. You got major Chinese smelters have pledged to discuss potential production cuts to counter some cutthroat competition on the market. So basically, you have miners pay refiners to refine their metals, and that price has been falling. So refiners are getting really squeezed, and they're trying to figure out what to do about it. So for more, we want to bring in Natasha Kaneva, head of global commodity strategy over at JP Morgan. Just start with copper for a second. Do you get the read that that's a strong demand pull, why refiners have been working overtime, or is that just tighter mining production, and that's sort of driving down that price?
Well, I think it's a combination of both. On one side, you definitely have a very resilient global economy. You're absolutely correct the way you described it. It's not just resilient, but the growth is broadening out, yes. Previously, it was just the service sectors that was driving the recovery in 2023, and it was U.S.-centric. Right now, we have a confirmation for 3 consecutive months that the PMI is actually recovering, and this recovery is broadening out from the services to the real economy, as you pointed out. This is manufacturing, this is industrial production. Not only that, we have signs that it's not just U.S.-driven. Europe is recovering as well, and China actually stable to slightly improving. So demand is actually very good across every single commodity under our coverage. But where you're correct, Alex, is that supply is underperforming as well. We had 2 very significant mine issues in December. It's the Cobra Panama in Panama, and then we had Anglo American downgrading their copper supply numbers out of Chile. And today, of course, we have the news with the Chinese smelters getting together and saying, as you pointed out, wait, we're not making enough money. Maybe we should start cutting production. It's about 300,000 metric tons of that. It's substantial, and if it starts piling up, that definitely makes a difference. So big rally today. Our target is $10,000, not in 2024. It's somewhere early 2025, but definitely we believe that the fundamentals are strong enough to support those levels.
So that's a clear way of saying it's a supply and a demand story. Like we're firing
100%.
on a lot of cylinders with commodities, and if you think about it, if I were to tell you that commodities really outperformed so far this year when we're entering a world of, say, Fed and central bank cuts, I don't know if I would have believed you, and yet here we are.
Here we are. So commodities were a very big deflationary story in 2023. So if you look at the US CPI peaked at 9.1 in June 2022, yes? Last year, December, we closed at 3.4. So 2/3 of that deflation in the U.S. headline CPI was driven by commodities. The biggest chunk out of that was oil price. Yes, going down from $130 to about $75. But, big deflation in the food prices as well. So this year, commodities are not going to be a deflationary force anymore. Best case scenario, it will be neutral. Worst case scenario, actually, they will be inflationary.
Yeah, we've already seen some pretty interesting gains, and even in the soft commodities. Let's talk about gold for a second, because that's been on a tear as well, and that there does seem to have a direct correlation to what we're seeing with the Fed and interest rates.
Yes, that's so we upgraded gold to a buy in December 2022. That it is our #1 trade recommendation for 2 consecutive years. Our target is 2,300. Monday, we hit a record level of 2,200. We believe that we can, 2,500 is a possibility because the market tends to get overexcited. For that, we need a confirmation from, continued moderation in the inflation and in the jobs numbers as well, and the confirmations that Fed indeed is cutting. So, but overall, yes, we think there is more to go. All right,
let's talk about oil, because there have been some interesting moves in that space. I don't know, it felt like a while ago we were all, wringing our hands saying oil was going back up to $100, and then it just kind of petered out, and it's kind of been doing nothing until recently.
It's up 15%.
I know
Don't say that.
Yeah, I mean, we're up 10% on Brent or WTI or whatever it is these days here. But what's driving that? Is that real?
It is real. Yes, it is real.
Yeah.
So actually, oil is trading today exactly where it's supposed to be. The fair value is $83 in March. So it's actually doing exactly what it's supposed to do. The demand is good.
Okay.
Demand is really, really good. It's really resilient. People are flying. People are driving. We can absolutely see that demand is very supportive for that. So to us, the target is high 80s by May. We again see a very strong possibility that actually the market will overshoot. We can see 90 May, June. And then, of course, what happened last weekend in OPEC and surprise announcement from Russia that they're cutting production. The market seems to be doubting then. Our view is that actually it's credible, that indeed they want to see their production declining to 9 million barrels per day by June.
What would a breakout look like? And what would be a trigger for that?
So it would be similarly to what happened in September or August, September of last year. It would be inventories. So the market will wake up one day and the inventories are drawing down and everybody will start saying the market is very tight, and then you'll
Is the breakup like 90? Like, is it $10?
$10 higher. It's always 73, 83, 83, 93. So it usually moves in $10 increments.
All right, Natasha, always great to talk to you. Natasha Kaneva,
Thanks for having me.
A wealth of knowledge as the global commodities team over there at JP Morgan. And we do want to stay in the commodity space, but turn back to equities, because one of the big stock movers today is U.S. Steel. Those shares down more than 12% here on the day. And a lot of this has to do, of course, with, I guess, that proposed tie-up with Nippon Steel. And now Bloomberg reporting that President Joe Biden here in the United States is expected to release a, quote, statement of concern to the Japanese government here, basically expressing U.S. objections to this deal. A statement of concern, while not necessarily binding, would have best effectively put the kibosh on this.
Yeah, and it's up for review anyway for CFIUS, the Committee on Foreign Investment in the United States. They want to kill the deal over national security concerns, but the difference is Japan is a close ally versus if this was a Chinese company, you would have bet that would never even have happened. It would have been shot dead right away, but Japan's supposed to be an ally, so that's actually quite interesting.
Yeah, but this gets to the whole issue now. I mean, nobody really wants to do cross-border deals. No country really wants to allow these cross-border deals, even if it is from an ally. Everybody is just all about protect your own universe here at all costs.
But I think the other issue is if prices in the U.S. are going to fall in relation to global steel prices, right? Because getting a global steel price is impossible. It's like totally factioned all over the world. And if you don't get a good enough price here, then you just can't stay in business. So then it defeats the purpose, right?
No.
Like you need money from somewhere to stay in business when prices are low, and you need them to stay in business so you can build your own supply chain. So you can't have both. 1 + 1 does actually equal 2.
Yeah, there's a reason why when you drive through the Midwest and Chicago and all those old steel plants are now not steel plants anymore.
Yeah, exactly. You need the price. You need the price.
All right, maybe trouble for the steel industry, but trouble for TikTok as well. That's our next topic here on The Big Show. The House of Representatives down in Washington passing a bill that would actually ban TikTok in the U.S. unless its China-backed owners sell the short-form video app. It's still got to make its way through the Senate, but the president is on board with that ban. We're going to have the latest for you after the break on The Close on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
That's the responsibility of Congress. That's our responsibility to guard against these kind of national security issues. That's why we acted on this. We're not talking about banning TikTok. This is up to TikTok. This is up to ByteDance. They make the decision on whether they want it to go away or whether they want to divest themselves of the ownership of this.
Representative Buddy Carter, a Republican from Georgia, speaking a little bit earlier here about that bill in the House of Representatives, a bill that did pass and would ban TikTok in the U.S. unless ByteDance, the Chinese owner, sells the social media app. Here with the latest from Washington is Bloomberg national security reporter Daniel Flatley. Dan, let's first start off with the next procedure here. This has to make it through the Senate, but we've already heard from the president, or at least his spokesperson, who has made it clear that he supports this ban. How much support is there for this ban in the Senate right now?
Yeah, it's a great question, Romaine. I mean, I think that there is, if you polled the Senate, you'd probably find majority support for something like this, no question. But the Senate is kind of an interesting body. It's smaller than the House, obviously, and each senator has more power. So you have committee chairs who are looking to sort of put their stamp on this, maybe looking to take things in a slightly different direction. I mean, if you look at what Karine Jean-Pierre said in response to questions about whether the president would support this, she said that she was happy that it passed the House, that they look forward to it passing the Senate, but she did say a crucial phrase, which is technical assistance. She said the White House would offer technical assistance, and she said that they want to put this bill on a solid legal footing, which has kind of been their standard line, but it seems to indicate that there may be some changes that they might look to make as it moves through the Senate, and that could complicate things depending on what happens there.
Dan, also my question is that if and lots of ifs, if ByteDance was like, fine, we'll sell whatever portion of TikTok or whatever version, whatever that is, the question is then who would buy it, right? It looks like it would have to be kind of the Metas of the world, which case those social media sites would get bigger. Would the administration be okay with that?
Yeah, you know, this has been a major topic of conversation in the hallways on Capitol Hill today and yesterday. Who would buy TikTok? As you mentioned, Meta is already a huge social media giant. The Biden administration has looked at a lot of big tech companies with sort of a wary eye on antitrust grounds. They're working, there's a few cases pending against some of these companies on antitrust concerns. So, you know, the question is who would buy TikTok? It's very expensive. It's more valuable now than it was a few years ago when Trump tried to ban it when he was in office. And I think that, you know, the other question is 6 months, is that enough time to really bring about a sale like this? It's you know, that's one of the concerns that a lot of the bill's opponents in the House cited, not just the fact that this came to the floor so quickly, but that it doesn't really or may not give ByteDance enough time to find a buyer.
And we should point out, ByteDance has already responded to this, or rather I should say TikTok, basically saying they plan to lobby the Senate on this issue, and at least for right now, they're making no changes right now to their business practices. From a national security perspective, Dan, I mean, I get the hype around this, but is there really substance to the perceived threat of this data collection? Data collection, we should point out, pretty much every social media platform and tech company for that matter does right here in the U.S.
Yeah, I think, you know, that's a great point, Romaine. You know, a lot of folks who are, again, opponents of this bill say they have concerns about data security, but that this bill does not address those concerns because, as you point out, a lot of these social media companies will sell data or collect it in other ways. I think that what really has given lawmakers a very strong argument here is the connection between ByteDance and the Chinese government. And there is a law in the books that China could ask companies within its remit to turn over data. And I think the real question with that is not just the richness of the data and the algorithm and the kind of data that it collects, but also could that be married up with some other data that China has collected for risks there.
Hey, Dan, thanks a lot. Super appreciate it. Bloomberg's Dan Flatley joining us there on TikTok. TikTok? TikTok, sure. That's TikTok's cousin. Why not? Coming up, Ellen Lee, portfolio manager over at Causeway Capital Management, will be joining us right as we head into the close. This is Bloomberg.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is the countdown to the close. Romaine Bostic alongside Alex Steele. It looks like some of the big gains that we had earlier today, that's kind of faded here. The Russell really holding in the green, but only fractionally on the day. The rest of the market in the red.
Yeah, NASDAQ 100 around the lows of the session, down 0.7 of 1%. But here's a stat for you. Ready? S&P's gone 265 sessions, now 266, without a drop of at least 2%. We haven't seen that since 2018.
Yeah.
This is like day by day, you'll like pick away at my resistance to the bullishness.
But that's also a good thing, right? I mean, do you really want to see 2% moves, whether it's up or down, those types of extreme moves that we had gotten used to? I mean, sometimes, 0.5% up one day and, 0.25% down the next. Maybe that's a sign of a healthy market.
Maybe. And again, I like the rotation. You get the materials, you get energy, industrials, the Russell, like those feel to me like better signs.
And that's the big question right now. A lot of people are saying that there is a rotation afoot. You see that with big tech stocks sliding today and small caps outperforming. We had a chance to catch up with Jason Trennert at Strategas a little bit earlier about the shift in investor sentiment.
The U.S. economy certainly seems among to be the strongest in the world, and so I think people have a little bit more confidence in some ways just moving away from things that they know will provide them growth regardless, which is tech, and now they're focusing on things that are a little bit more cyclical and a little more dependent upon a continuation of the business cycle.
And that was Jason Trennert. He joined us at the top of the hour to kick us off to those closing bells. Here to help take us to the bell is Ellen Lee, portfolio manager at Causeway Capital Management. And Ellen, the big question right now isn't so much as whether there are cheap stocks out there. There are. But is the value enticing enough to continue this rotation?
I think, at this point of the market, what really is important is to see companies execute. And it really is dependent upon if companies are delivering what they're promising. And across the whole valuation spectrum, I think if the company is able to execute, regardless of where you are in the multiple valuation spectrum, I think the market will reward that. And hopefully the expectations and the value stocks will be lower than what people expect. However, even if you are at those multiples, if you don't meet your expectations, I think the market is going to be very judgy on how the stocks will react. So at this point, if you're doing earnings delivery and meeting market expectations, I think you're in a good position. And as you talked about in the previous segment, there is more room in the value names because expectations are lower.
The expectations are lower, but we've started to see a little bit of a perk up in that earnings growth and revenue growth for the small and mid-cap names. That's certainly been evident this earnings cycle. To a certain extent, Ellen, in certain pockets of that small cap space, have actually done a little bit better than some of those large cap companies.
Yes, I think it's a combination of the fact that the economy, U.S. economy, is doing well. And unless there's any event for us to think that the economy doesn't have legs, I think that should continue.
Do we need a Fed rate cut for it to also continue? Or is it more important that the economy's good and we don't get the cut?
I mean, obviously, that's the trillion-dollar question. But the reality is, I think the market's also recognizing, even at these rate levels, the market's doing okay. The real economy is doing okay. So I don't think there is an expectation of a huge rate cut that needs to be precipitated, and things are chugging along.
That's what's so amazing. It's like we're chugging along, which pushes back the rate cut, but again, the economy seems to be able to handle it. So what's going to be my next catalyst? We're through earnings. We're through that narrative. It's going to be hard to disrupt that narrative. What now do you trade off of?
I mean, for us at Causeway, we're really looking at company fundamentals and earnings delivery and looking at companies that can deliver earnings irrespective of the operating environment or have managed communication to a level where, their expectations are manageable. So at the end of the day, we are looking for companies to just chug along.
Okay. Are there any specific names that excite you right now?
Well, there's a name in the UK, Reckitt Benckiser. Mm-hmm. It's basically the maker of Lysol. They gone through, obviously, the COVID ups and downs with Lysol, but also they were beneficiaries of product recall of Abbott infant formula in the US. And there seems to be less visibility because of these peaks and valleys they had to go through. But long term, we think there is good value. It's a consumer staples company trading at a multiple that's akin to GFC levels. So we think there's really good value there, and they've continued to do share buybacks. So things within the control the company is dictating.
Well, what about in the discretionary space? I mean, there's been so much talk about consumer spending, whether that's going to hold up. Do you find some confidence to wade into those waters?
Well, one consumer discretionary name we like is Kering, the maker of Gucci. Obviously, Kering, a luxury goods company, operating in China, that has really brought valuation down. But now with the new creative director there, we feel product refresh will really ignite sales. And what's also interesting, Romaine, that I would point out is, consumer sentiment or consumer confidence are very bifurcated depending on your income levels. Today we saw, I think Dollar Tree announced that the lower income customers are struggling. But if you look at the sales of luxury goods, actually the middle to higher income consumers are doing well as real wage growth is really there.
It's interesting though. You picked two companies that are not U.S. companies, and I wonder if that says anything about valuation for the S&P versus European companies.
Oh, well, thank you for pointing it out. It just seems, U.S. market is a little bit frothier, in my view. And if you actually look at the numbers, I understand U.S. markets should trade at a premium to international, but the level is really, really high. Of course, U.S. market has more tech, so some of that is justified, but we do see more value in international. And if you think about the appetite for stocks in Europe, with onshoring or reshoring in Europe and all the infrastructure investment that will happen with energy transition, I think Europe is in a better place than before. And, I don't want to say it's different this time around, but I do. There's a little bit of tailwinds that didn't exist before.
All right, Ellen, going to have to leave it there. Ellen Lee, portfolio manager at Causeway Capital Management, helping us count down to the close here on this Wednesday afternoon. We only have about 2.5 minutes until we get to those bells here. A little bit more of that seesaw that we've seen really over the past few weeks now, right? Where we get a decent rally and then you kind of get that little bit of trickle of a fade. I don't know. Does this bounce back tomorrow?
I don't know. You tell me.
You tell me.
No, you tell me.
You.
No, but I'm asking you second. No, you asked me first. I asked you second. Would it bounce back from what?
Yeah.
I mean, you could definitely continue to see the rotation into small caps.
Yeah.
You have retail sales though tomorrow, so that could be a decider potentially for that.
Yeah, I think the retail sales numbers maybe gives us a little bit more insight into just whether those economic conditions are going to hold up. Our full coverage right now of all the market action today as we take you to the bell and beyond.
Beyond the bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. Here to help take us beyond the bell, it's a global simulcast. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth as we welcome all of our audiences across all of our Bloomberg. The what?
The fishbowl.
Is it okay?
Kind of.
Right.
Because we're all fish, we have no memory.
What does that mean? I should just come by and sprinkle some food on
Because
top
you're
of
on
it?
display when you walk by the radio studio. That's why. Or it's like where the monkeys are. Feed the monkeys. All right, I digress.
I don't know where to go from there.
I'm just happy it's Wednesday. I'm going to talk about the copper space. Copper stocks are up. There's no segue there. Copper stocks are up. The base metal climbing. This on the potential for capacity cuts at Chinese smelters, if you will. So if you look at the Global X Copper Miners ETF, folks, it is up more than 7%. And I'll have some more names when I get to my gainers later on. So
Another day, another record for Bitcoin. Fourth time in 6 days it's reached a record. We are seeing a lot of inflows into the ETFs. BlackRock saw a record $849 million in inflows just on Tuesday. Bitcoin up about 70% so far this year.
I'm looking at the re-rating, or what seems to be a re-rating of Tesla. It's the worst performer among the Magnificent Seven. And for that group over the past year, it's the only member to decline. Everyone else has gained, but Tesla's down 3%. Wells Fargo is saying it's a growth stock without growth. It sees zero growth in sales volume this year.
I asked earlier, can it be a growth stock if there is no growth?
That was
the
harsh.
answer from Wells Fargo is no.
Sorry.
That was definitely a harsh note from Wells Fargo, for sure. But clearly, market holding up okay despite the Tesla rolling over the last couple weeks.
Yeah, interesting market, though. You look at all the names that are moving higher here, you're not going to really find any real tech names out there. I think PayPal is only one, and that's kind of tech-ish, if you will. The Dow Jones Industrial Average is going to manage to squeak into the green on the day, up about 0.1%, though it had been significantly higher earlier in the session. The S&P 500 closing in the red, down by about 10 points or 0.2%. The NASDAQ down 88 points or 0.5%, while the Russell 2000, which at one point was up as much as 0.7%, giving back some of those gains, but closing out in the green, up 6 points or 0.3%.
All right, staying with the S&P 500 for a moment, folks. 265 names to the downside. Scarlett, 236 losing ground in the Wednesday trade and 2 unchanged.
All right, let's look at the sector performances here. You've got energy, the clear outperformer, up 1.5%. The pie overall is a real mix there, though, because you have technology down more than 1%, and that's Tesla, really, the drag there. Real estate investment trusts off by 0.6%. Healthcare losing a little bit of ground there, but the strength is in those commodity names, energy materials, as well as utilities.
All right, guys, let's get to some of the individual gainers, if I may. Number one, gainer in the S&P 500. I talked about the copper stocks rising in today's session, some of the miners. So Freeport McMoran, it is the number one gainer in the S&P 500. A gain just off its highs of the day, but still with a gain of about 7.6%. We mentioned the potential capacity cuts at Chinese smelters, so that gave a lift, if you will, to the overall space. Let's go to what was a top gainer among the NDX, the NASDAQ 100. And we're talking about PDD. This gaining, what is it, about 3.5%. It was up as much as 8% earlier in the session, but finishing the day with a gain of about 3.6%. The company hiring Aaron Webster from SoFi Technologies to help the payments. Oh, forgive me. I'm sorry. I jumped ahead.